This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call. You're watching us live from the CNBC-TV18 Motilal Oswal studio. I'm Sonia, with me Surbhi and Nigel joining in. And folks, today is the last day of the trading week.
So
and
the smiles are wide, the colors are vibrant, right? I think it's quite palpable in the air in the studio today.
And it's also a very exciting week coming up, right? It's truncated, only 3 days, 3 working days that is. And there's Holi, there's IPL starting later this evening. So excitement galore.
Well, plenty to look forward to on the personal front with regard to all these holidays coming up. But I guess we've got a market to deal with. And today, tech stocks are going to pull back a little bit. So let's get straight to the action.
Oh, yes, absolutely. And that's the big question we're asking this morning, right? Can Nifty hold on to the 22,000 mark, which it's so, with so much effort, it got back to that level yesterday. So a couple of cues that you need to watch out for. The global setup is looking very strong this morning. Once again, global markets have moved higher. In fact, the Dow went up about 270 points. This is on top of a 400-point rally in the preceding day. Fresh record highs on all 3 indices this morning. And not only that, not just in the US, but look at what's happening in the Japanese market. The Nikkei market has crossed that 41,000 mark for the first time ever. This despite Japanese inflation accelerating in the month of February. So very good over there. But, you know, as Nigel was pointing out, the big thing to watch out for in our own markets is the way IT stocks could perform after what came out with Accenture's guidance. Accenture went and lowered its guidance to 1 to 3% from 2 to 5% for the fiscal year 2024. And cutting full year guidance will definitely have a sentiment overhang on a lot of the IT stocks, which in any case have been on the back burner in the last couple of weeks and months. So I'm watching out for that. The other space I'm looking at this morning is the PSU stocks, because yesterday the index went up 3%. And remember, PSU stocks across the board have corrected 25 to 30% from the top. And now this is the first real signs of a pullback that we are seeing in the month of March. So it would be interesting to see if there is any follow-on buying in the PSU names. Is it just a dead cat bounce? So more on that, of course, to come. But watch out for these 2 pockets, the IT stocks because of Accenture and the PSU stocks because of the pullback that we've seen. Now, there was large selling from FIIs yesterday. So FIIs sold about 1,900 crores in the cash markets overnight. But next week is truncated. There are just 3 working days. So the volumes will definitely be on the lower side. However, lots to watch out for. Global setup is looking pretty solid, Surbhi.
Absolutely, Sonia. Yeah, and it's a central bank party, right? When they get going, then there is very little you can do. And that's what played out in our markets, because a lot of what we saw yesterday was short covering. We saw that on the indices, on the Nifty and the Bank Nifty. But just first up, I mean, a little more on this central bank party. It's obviously the Fed and also the Bank of England. Let's not forget what happened to the FTSE yesterday, because the Fed has kept the door open for 3 rate cuts this year. Bank of England is singing the same tune. They did not go ahead and change policy, but I just want to go over the statement that came in from the BOE yesterday. The BOE governor went on to say, and I quote, "We're not yet at the point where we can cut interest rates, but things are moving in the right direction." That was enough to get the equity bulls all excited. Yesterday, the Swiss National Bank went ahead and already cut. I mean, they're the first major bank, central bank to cut rates. 25 basis points of a rate cut is what we got. Interestingly, today morning, Asian markets are a little more sober, barring Japan. There is a fair amount of red, so some profit taking that's taking place in the broader neighborhood. Hong Kong in particular is down a little bit. The other thing to watch out for is that while equity started this whole rate cut hope party, the money markets are taking things with a pinch of salt, because the dollar has moved higher. In fact, the dollar index is at 104 right now. And despite all this commentary from central banks, there's no major drop in yields. Let's not forget that. In fact, the 2-year note yesterday was up a couple of basis points last night. The 10-year yield was still flat. So yields are not exactly celebrating and falling. But in any case, I mean, it was enough to get that big move going for us here as well. So just some more internals from yesterday's trading action. As I said, it started with short covering, but we had a great broader market rally. So that was a good point. The VIX was down 7% yesterday by the time we ended up. And if you look at some of the cues coming in from the F&O market, that major, war point, that war zone, which is 22,000 on the Nifty, yesterday it seems like the bulls kind of swung it in their favor, because if you're looking at total open interest, then there are far more put writers now at 22,000 on the Nifty than call writers. So that's an indication of perhaps at least medium-term bullishness coming in. In terms of technicals, the Nifty yesterday managed a close above the 50 DEMA. the day exponential moving average. And the bank Nifty had its first positive close after 9 straight red sessions, 9 straight loss sessions. So the internals look positive. But Nigel, for me, I think 2 key questions: whether this can continue in the form of, more concrete cash market buying as well. FIs were absent, as Sonia mentioned yesterday. And the second is obviously IT, because today we have that one big sector that's bound to, give us a bit of a shake-up. Let's see if banks, Reliance, if the other batsmen can come to the crease and support.
Well, one of the factors that played out on the dollar index strengthening was because the Swiss franc was weaker, right? Post that rate cut. And the good news, though, is that Brent crude prices have cooled off a little bit. So I think both those two will offset each other. But let's look at the top 3 points that I'm looking at for today's trading session. One is Accenture's numbers were a bit of a disappointment. And that's what's going to be leading to some pullback on the IT-related names. So the onus moves to Reliance Industries as well as banks, because someone will have to bat for the bull. So I'm looking at both these two. And the broader markets, well, they could outperform because you have, volumes that are a little bit tepid. And towards the end of the year, sometimes you see a bit of an outperformance coming from the broader markets. Yesterday, the breadth of the market, by the way, was very, very good. But volumes, they've been absolutely, much lower that, in comparison to the averages. So that's the average for March prior to the start of this week. And that's the volumes this week. And I guess with the long weekend, with a lot of holidays, we're expecting cash market volumes at least to be on the lower side in comparison to what we see on averages. The point that I was making, IT-related names, they're close to 15% of the Nifty. So the onus moves to Reliance Industries as well as banking names, which have close to 30-31% on the index. So both those two will have to outperform and make up for the weakness that we'll see on the tech-related names. Moving on to the F&O action then. Yesterday, you did have more long positions added by the FIs in comparison to short positions in the ratio of close to around 3:1. And looking at the swing factor, well, the net short positions came down from around 95,000 contracts to little sub that 90,000 contracts odd because of the movement that we saw in yesterday's trading session with higher amount of long positions that getting added, though they continue to remain net short. What are the levels we're looking at? On the Nifty Bank, very, very crucial. That 47,000 mark remains elusive. The 20 DMAs around them. Yesterday, we almost went to around the 47,000 odd mark, but we couldn't conquer that. So that becomes a bit of a resistance zone. On the downside, that 46,000 mark becomes crucial, and that ties in with the 100 DMA. On the Nifty then, what are the levels you're looking at out there? Well, yesterday we went ahead and we conquered the simple, 50-day moving average, in yesterday's trading session. And, if you look at it, the 20 DMA remains elusive for us. And, that's the important one as well. The low that we recently saw, which is actually 21,710 odd. The stock that I'm tracking is Lotus Laboratories. Important to see how that stock moves today. Yesterday, there was a big amount of delivery-based buying. The volumes yesterday were very, very high, and delivery-based buying is what we saw as well. Though the stock faces some resistance at around that 400 rupee odd mark. So that's going to be important for the time being. I'll keep an eye out on that one because the volumes were large yesterday, and it has a crucial, technical barriers ahead at around 395 and around that 400 rupee mark. So that's the one I'm looking at, guys.
Okay, well, thanks a lot for that, Nigel. Let's kickstart the show. So much to talk about. Let me tell you what's lined up in the first half hour of the show. We'll get you updates from the markets across the globe. Richard Harris of Port Shelter Investment Management will be joining in to discuss the global setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At 8:30 a.m., we'll do a fundamental stock analysis with Siddharth Khemka of Motilal Oswal Financial Services.
Okay, let's move on to some money market views now. Lakshmanan V of Federal Bank says the FOMC and Bank of England kept interest rates unchanged while the Swiss National Bank cut policy rates for the first time in 9 years. He says gold scales all-time highs as the dollar index and US yields decline on a slightly dovish Fed outlook. He adds that the rupee had weakened before the FOMC announcement along with the dollar demand from domestic banks. He's expecting the rupee to trade in a range of 82.88 to 83.30 to the dollar in the upcoming sessions.
All right, and on the bonds, Lakshmanan says the government bond yields retraced after inching higher through last week. He says the fall was largely tracking US Treasuries after the US Federal Reserve maintained its outlook for 3 rate cuts this year. He adds oil prices edged lower after hitting multi-month highs to hit the $87 a barrel mark amidst heightened geopolitical risks. Lakshmanan adds that coming sessions could see the 10-year benchmark bond yield trade in a range of 7 to 7.1%.
Okay, all right. So those are some of the cues you're getting on the money markets as well. Let's kickstart then with our first guest on the show. We have Richard Harris, Chief Executive at Port Shelter Investment Management, joining in. Richard, hi, good morning, and thank you so much for being with us. So central banks have sparked a bit of an equity party, haven't they? The Swiss National Bank is first off the block. The BOE is promising that things are moving in the right direction. And Fed says you can still expect 3 cuts this year. Could this revive market sentiment? And are you expecting further upside for some of the large global equity markets?
Well, I think the market sentiment has already been excited by all of this. Of course, markets tend to predict, these kind of things happening. So we have to think that maybe the immediate positive impact has gone through. But there's absolutely no doubt that the consumer is very strong, that there's low unemployment, which is keeping the markets going, that liquidity has created a surplus of money, certainly in Western markets, and that there's a momentum that's been building that's actually extending this liquidity boom further on. So we've seen the liquidity, we're seeing velocity of money, I think, quite high at the moment too. So all of this is driving a lot of markets to all-time highs. The real pivot point was really at the end of January, though. If you look at many of the markets, and indeed many of the commodity markets, that's when they first started to move. So I think that a lot of what people may be thinking of interest rate cuts is already in the market.
So how are we feeling about emerging markets like India? Because, global markets like Japan, the US markets are all sitting at record highs. Here in India, we're not too far away from our record highs, but little bit of caution now entering the system. How do you think an average investor should approach it?
Well, yes, there is some caution in the system. My general feeling is that this fairly positive tone in the market is likely to continue maybe for 2 or 3 quarters. There's a lot of momentum there. Of course, we're always dependent on the odd events that may come around that may topple the markets from their current positive state. But at the moment, I think that that's likely to continue. That will probably mean that also the Indian market will be underpinned. And even though the Indian market has really slowed down in the last month or so, we've got to remember that the market has seen an extraordinary move, extraordinary rises over the last several years. And that can only be put into context if you look at China, which has done the opposite.
Hi, Richard. Morning and good to see you in. So a couple of quick points then. Do you expect India to continue to outperform China? I recall you telling us that, a couple of months ago as well, that you're seeing an increased amount of allocation to India in comparison to China, and that's been the case. And also, how many rate cuts are you factoring in? Because that seems to be, anyone's guess as of now. How many? And is it going to be in the second half of the year? Or do you expect it to be sooner?
Well, the second question first, probably because it's the easiest one. The dot plot is showing 3 cuts this year. I think that's fairly ambitious because with the US election coming up, we're in a situation where it's going to be very difficult for the Fed to move either up or down during the hot period of the elections. So I suspect there's room maybe for 2 cuts. And I suspect they'll be largely cosmetic because, let's face it, 2 cuts is just 50 basis points, and that only takes interest rates down to around 4.75%, which is still quite high. So we're talking about cuts, but this is fairly marginal. So I would actually be looking more at 2 this year. That may well disappoint the market, which will put a bit of a headwind on price movements, say from mid-year. But I think the general feeling will still be that investors will still want to get in the markets at that stage. So the picture of interest rates cuts, I think, is actually rather more muted than the market is seeing at the moment. In terms of China v. India, I think we're seeing China in a pivot at the moment. It's starting to recover. It's recovering slowly. And I think their recovery will continue to be slow and will probably underpin growth around the world. If it was too fast, we'd see commodities and oil go up, and that could hinder growth. But I think slow growth in China is likely to underpin growth around the world, which will obviously be good for India as well.
Yeah. Richard, on our screen, we have a chart that really tells the story. The Nifty is up about 30% in the last 1 year, whereas the Hang Seng is down 14%. If you look at broader Chinese mainland market indices, then the gap could be even wider, perhaps. So, what are you doing in India? Any changes to the stance here, the portfolio, and what are the themes that you're liking? I mean, the government-owned stocks, they've had a fantastic run. Do you like this part of the market, or any specifics on India?
Not really. I'm not really a specialist on India. I think a lot of your other viewers will have better views. I can only really talk from an international investor's point of view. And from my point of view, I think things still look fairly positive. I mean, clearly, we've got political issues coming up. That may affect the market. But my general feeling is that unless there's a major change, political issues tend to be short-term, but economic fundamentals tend to be long-term. So I think investors should focus more on the economic fundamentals than political. There's one great exception to that, of course, and that's the US election, where if Trump comes in, he is likely to change things. I suspect not for the better. And I think that the markets will probably feel the same if Trump looks as if he is going to win victory in November.
All right, we leave it at that, Richard. Thank you for stopping by and speaking to us on CNBC TV18. That's the word coming in from the global market expert. Let's take a quick break. Plenty of stocks to talk about. Accenture has cut its guidance, so that will definitely impact IT stocks. More on that in a bit. Stay tuned.
Welcome back. So the global setup is looking fairly okay, barring the bit of a cool-off in Asia that we're getting. But what about individual stocks? Well, we've got our team standing by with the CNBC TV18 list of top stocks to watch for the day, guys. Good morning. Rima, you've got all eyes on you because it's your sector that's going to be in hot focus. Thanks to this guidance cut and fairly muted, very cautious commentary that Accenture came out with. So tell us more.
Oh, absolutely. And Accenture share prices were down more than 9% on a muted Q2 FY24 numbers and the cut in the full year guidance. So for the quarter gone by, Q2, the company reported a flat revenue growth. While it's within the company's guided band of -2 to +2%, it missed street expectations. They've also gone ahead and lowered the guidance for the full year. They're now saying FY24 growth will be at 1 to 3%, versus their earlier guidance of 2 to 5%. And the key reason for this cut in guidance is the company continues to see client caution in IT projects, particularly the smaller projects. So the large-scale transformation projects continue to remain on track, but the smaller ones are getting hit, and that's the reason why the company is not has gone ahead and cut the guidance. Now, this is a negative read-through for the Indian IT companies, and yesterday both Infy and Wipro ADR ended lower. Infy ADR down more than 3.5%. But there are two positives in the numbers. Now, Accenture's business is a sum of parts of consulting, which is very high discretionary, and then they have the traditional outsourcing business. Now, if you see the guidance of 1 to 3%, in this, the outsourcing revenue is likely to be mid-single digit. The problem is more in consulting. But that said, it's still disappointing because the street was anticipating a double-digit kind of a recovery in FY25, and Accenture is talking about a mid-single-digit kind of growth. And generative AI is picking up quite a bit. On a quarter-on-quarter basis, Gen AI bookings are now standing at $600 million versus $450 million that they had in the prior quarter.
All right, thanks a lot for that. Well, let's go across to Vivek now. He's tracking Texmaco Rail and Karnataka Bank. Vivek, why is that?
Well, good morning. Both of these stocks I'm tracking because the companies have gone ahead and decided to do a fundraise. The route taken by both of the companies is the QIP route. Now, Texmaco Rail, they've informed the exchanges that they've launched the QIP last evening. Now, according to sources, we had access to the term sheet as well. The issue size for Texmaco Rail is up to 250 crore. The indicative issue price is at 155 rupees a share, which implies a dilution of slightly over 4.2%. What is the company going to use the funds for? Number one, repayment of borrowings. Number two, for funding working capital, and also for general corporate purposes. Now, the second stock on the radar is Karnataka Bank. Last evening, this company too went ahead and said that they would be launching a fundraise. The total deal size is 600 crore, where the base size that the company is looking to raise is 400 crore, with an upsize option of an additional 200 crore. The price band for this particular fundraise is 225. According to sources, the demand for the Karnataka Bank fundraise is quite strong, with almost 60 to 70% being subscribed by long-only funds.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Sonal. She's here to tell us about a couple of stocks that she's tracking, Prestige and Tata Chemicals. Hey, Sonal.
Good morning, Nigel. Well, Tata Chemicals, I'll talk about it first up. The stock has been under pressure in the last couple of trading sessions, and it could continue because they have received a penalty notice from the Income Tax Department, which is to the tune of 104 crore rupees. It has actually come in from the faceless assessment, to which the company says that they will appeal against the order, and they are quite sure that they will get favorable order from the appellant authorities, but there could be some impact of this on the stock. Prestige Estates, there's a positive news here because the company, through its subsidiary, has acquired 62.5 acres of prime land in Indirapuram extension in the NCR region. They already have some exposure to that market, but they're increasing it there. The company says the cost of acquisition is around 468 crore rupees. They will have some revenue share as well. But they say the opportunity or the gross development value is around 10,000 crore rupees. To give you some perspective, their FY24 sales could be around 20,000 crore rupees. So this is half of what they are doing right now. So looks like a big opportunity here. The stock will be on our radar as well.
Okay, got that. So we'll watch out for Prestige Estates. Thanks for that, Sonal. Upasana is looking at a bunch of stocks as well. Upasana, good morning. Tell us about them.
Well, good morning, Surbhi. First up is Bharat Dynamics. The company will be in focus as the board approves stock split in the ratio of 1:2 and even interim dividend of rupees 8.85 rupees per share. The board also appoints G. Gayatri Prasad as the CFO of the company with effect from March 21st, 2024. Well, next up is Sada Energy. This stock will be in focus as the JV Natural Resources Energy gets LOI for composite license of Surjagarh 1 iron ore block in Maharashtra. Next up is Tata Communications. The company said that it aims to hive off the company's new digital edge services business to its wholly owned subsidiary Novamesh on a slump sale basis. And the cash consideration is almost 458 crores is what the company has indicated. That's the reason even this stock will be in focus today. Well, next up is Star Housing Finance. The company inks co-lending partnership with Tata Capital Housing Finance, and it also aims to service 5,000 home buyers in low-income group segment in the first phase of engagement is what the company has indicated. And lastly, Coforge will also be in focus today as the company has issued further details on the purpose of its fundraising and type of acquisition being pursued. And the company says that it is opportunistic in pursuing its M&A strategy.
All right, thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow. There's Texmaco Rail, Karnataka Bank, Prestige Estates, Bharat Dynamics, Sarda Energy, Tata Communications, Star Housing Finance and Coforge. While stocks with negative news flow, there's Tata Chemicals and IT stocks. But let's also get a grip on what's happening in the world of commodities today. Manisha Gupta is joining in for a roundup of all the action from that space. Manisha, some cool off is what we've seen in crude?
It is, yes. And crude oil prices have seen a nearly 2% decline from the kind of highs that we saw almost 88, and now we are trading at around $85 a barrel. Well, the strength in US dollar is one thing that is weighing asset classes across the place. Apart from that, there is also a Gaza ceasefire possibility that seems to be coming back on surface, and that is taking premium off. The reason that you wouldn't see crude prices decline too much is because the U.S. inventories have continued to decline, and the Ukraine attacks on Russia refineries have shut down 10% of their refining capacity. So these are some of the factors that could continue to support. But yes, the strength in US dollar index has weighed on across board. So gold is off its all-time highs. Silver prices, which were trading at a one-year highs yesterday, also went down on profit-taking. And that's exactly what you are looking at in other metals as well. So copper, zinc, aluminum, which were trending with multi-month highs, also have come off of it.
Got it. All right, Manisha, thank you very much for the latest in commodities. We do have to take a break on that side. Come back on the other side and we'll touch base with Siddharth Khemka of Motilal Oswal Financial Services. We'll talk about a lot of the fundamentals, including, of course, this Accenture guidance cut. So back with more in a bit.
Welcome back. Hope you're having a good Friday morning. Well, for the time being, Asian markets are a little bit subdued, and you have the gift nifty that's suggesting we pulled back a little bit by closure around 50 points. So yesterday we had a good session, but today we'll give back some part of that. Hormuz, though, has done a lot of reading this morning. He joins us to fill us in with some of those brokerage reports. Hey, Hormuz, morning.
Morning, Nigel, and it's a Friday morning, as you just mentioned. We'll start off with some positive commentary from UBS, that's on Reliance Industries, and they've maintained their buy rating, but they have increased their price target on the stock to 3,420 rupees from 3,000 rupees earlier, and that is the highest target on the street now for Reliance. And they're mentioning that Reliance's earnings estimates were being revised downwards over the last 2 years, particularly due to the underperformance of the consumer-facing business, but that seems to be coming to an end as the earnings visibility of the consumer business seems to be improving, and a potential tariff hike in Jio could also complement strong subscriber additions that it has seen. So positive commentary there from UBS. Amber Enterprises has also been in focus of late, and CLSA has upgraded the stock to buy from its earlier rating of accumulate and has also raised its price target to 4,300 rupees from 4,130 earlier. And they are saying that the recent correction that the stock has had is an attractive entry point, and the weakness that has been driven predominantly by the broader market fall and expectations of near-term earnings being modest, those concerns are overdone. And even if the RAC market, which is Amber's core business, if that market share falls, the other businesses will complement over 50% of the revenue over the next 5 years. And HSBC has come out with a note on the cement space where they're saying that prices have fallen sharply in the fourth quarter, particularly in the south, north and western parts of the country, and they are as a result cutting their estimates and price targets to reflect that drop in cement prices. Now, among the stocks that they have a buy recommendation on, one is Ultratech, where they have cut their price target to 10,900 from 11,500 rupees earlier, and Dalmia Bharat, where they have cut their price target to 2,500 from 2,700 rupees earlier. Back to you.
All right, thanks a lot, Hormus, for that. Well, the other big headline that we're tracking this morning is Accenture cutting its guidance. It reported a flat revenue growth, but the important part is it cut its fiscal 2024 growth guidance to 1 to 3% from 2 to 5% earlier. What is the read-through for Indian IT companies? Manik Taneja, the Executive Director, IT Services at Axis Capital, is joining us now. Manik, hi, good morning, and thank you for taking the time out and speaking to us. You know, IT stocks in any case have been underperforming this market, and now here comes Accenture and cuts the guidance. What do you think the read-through could be for the top-tier IT companies?
So I would, first of all, thank you for having me on the show. And more than the reset in terms of numbers, I would say the qualitative commentary is more important. So if you realize over the course of last 3 or 4 months, there has been excitement building in Indian IT services companies that after the moderation in growth that you saw over the course of last 18-21 months, things could start to look up in calendar year 24/FY25 as Fed cuts rates, customers get much more confident, customers start to essentially spend, etc., etc. And because of which you have seen that even IT services companies have delivered positive returns. And also in the backdrop that NASDAQ has been doing extremely well. Now, what Accenture commented in their call last evening is the fact that while calendar year 24 budgets have got frozen, there is still pressure on short-term discretionary spending, and which is essentially a continuation of what has been in play through a better part of calendar year 23. Now, given the expectations from the street / investors has been that things will start to look up from April, May, June itself, I would presume that this will drive further cut in terms of growth expectations for FY25 when companies report in mid-April.
All right. Hi, Manik. Good morning and good to see you. And, you know, talking about the call yesterday, essentially, they highlighted that short cycle discretionary projects could take a bit of a knock. There were certain companies, you know, I'm reading various brokerage reports where they were factoring in some recovery in the short cycle discretionary spends. Now that gets pulled back, right? So I wanted to understand who gets hit harder and who is better placed.
So, see, from a near-term stock standpoint, just like the excitement started to get built up across names, similarly, some of this disappointment will also percolate to almost everyone in the sector. There were companies like Wipro who are talking about some recovery in terms of discretionary spending in the near term, although their quarterly guidance for JFM or Q4 FY24 did not reflect that optimism. So this will possibly be a sort of a dampener for the likes of Infosys, Wipro, and while I would say that it will essentially have negative ramifications for almost everyone in the sector.
Got it.
Manik, hi, good morning. And the thing is that, IT stocks, yes, we've seen a correction with the market fall in the last 3-4 weeks. But if you go back and see how the market rewarded IT stocks at the end of the previous quarter, at the end of Q3, there was a massive rally. Without any huge uptick in numbers or without any breakthrough management commentary. But the market was really bidding up IT. Some of that has corrected, but not all of it. In fact, not even half of that rally has been corrected in the last 4 weeks. So just purely in terms of valuations and market positioning, do you see immediate, at least knee-jerk downside because of what Accenture has said, and now we're running into the next event, which is Q4 earnings? And give us your stock preferences, stock calls as well. What do you like? What are you avoiding? What's your overall sector stance?
Sure. So the point that you made in terms of the stocks doing extremely well post Q3 numbers, and still only some of them, only some part of that has got corrected in the recent weeks. I would say a lot of that excitement is to do with what's happening broadly in terms of global markets. So Nasdaq is making new highs. Even even US as well as European indexes are doing extremely well. So some of that essentially is extending to Indian IT as well. From a number standpoint or from an outlook standpoint, I would presume that the guidance that the likes of an Infosys and HCL Tech will issue amongst the larger companies may disappoint street expectations. So we're looking at the street expectations being in excess of 8% plus for Infosys in FY25, with the expectation that Q1 FY25 ends up being very strong because Infosys had significant deal wins through the course of FY24. I would presume, given the backdrop, even Infosys guidance might disappoint when they report on April 18, although that might be cushioned by a potential buyback announcement given the capital allocation policy that they have.
Manik, what's the number? Manik, sorry to come in over here. As of now, I mean, what is the number that you were working with, let's say till yesterday, on the INFI guidance for FY25? And are you going to scale that down because of what Accenture has said?
Sure. So from a estimate standpoint, today our growth expectations for FY25 are about 6.5% growth for FY25. While, as I said, street essentially is in excess of 8% plus. And the number that we publish in terms of what Infosys could guide for FY25 is a range of 3.5 to 6.5%. Although with what we've heard from Accenture, I would presume that there could be downside to those expectations. So that's from an Infosys standpoint. With regards to our sector positioning, we have, so the only buy-rated stock for us in the large cap universe essentially is Tech Mahindra. And even Tech Mahindra has struggled through FY24, but we are looking beyond the near-term weakness in case of in case of Tech Mahindra, given the fact that that's the only large cap name which has a potential to deliver about a 15 to 18% EPS CAGR, once again, as I said, over the medium term, given significant possibility of improvement from a margin standpoint, from an operation standpoint. So that alone can be a significant driver of earnings growth for the name over a 3-4 year period. And that's the reason for preferring that name. Amongst the mid cap names, Zensar is a buy for us. We have sell/reduce across most of the other tier 2 coverage universe.
I just had one short question quickly, if we can squeeze this in, on generative AI, because Accenture did mention that spends for generative AI have gone up, projects have picked up as well. Would you extrapolate that into better business for the top tier players here? And if yes, which ones would benefit the most?
I would say right now, from a even when you look at Accenture size and the revenue contribution that generative AI that they are calling out for generative AI, that's a fraction of their overall business. Just like when cloud became the most important buzzword, everybody wanted to call out the proportion of the business coming in from cloud. Similarly, I would say for IT services companies, now people will start calling out the mix of their generative AI related business. But in the initial period, the Gen AI spending will not be a significant driver for services companies. It could be a bigger driver of growth for hyperscalers and software companies.
Okay. All right. We'll let you go on that note. Thanks a lot for joining in and giving us your quick thoughts on Accenture cutting their guidance and what this could mean for top-tier IT companies. In fact, Siddharth Khemka is also joining in. He's a head of retail research at Motilal Oswal. Siddharth, if you heard Manik, I mean, there's a potential of Infosys also cutting its guidance, perhaps, cautious commentary from the rest of the pack. As an investor in IT stocks, what do you do now?
Yeah, hi, very good morning. So I think last quarter we saw Infosys already cutting the guidance. So there is definitely some more risk after what Accenture has done and whatever the commentary is, and we heard in detail. So I think near term, we'll have a knee-jerk reaction today with the guidance cut and the expectation that the near term pain could continue in terms of demand, while the deal wins continues to remain strong, and that is something which keeps the hopes alive that things would recover maybe 1 or 2 quarters down the line. And I heard you rightly saying that some of the street was pricing in or penciling in a recovery from the 1 or 2 quarters down the line, but that could be also at risk. Having said that, valuations are comfortable and the long-term visibility is still there with the deal wins being strong. And we heard the US Fed commentary, how things changed overnight with the US Fed saying that the economy is very strong, inflation would come down and they would do the 3 rate cuts. So I think one near term, definitely there could be weakness, but there would be some recovery 1 or 2 quarters down the line and things would start looking better. Investors who are having a long-term view, having a patience to ride through the near-term volatility are the ones who are buying the tech stocks in this current market environment where we are seeing a lot of volatility, a lot of sector churn, and where I think IT provides that kind of safety in terms of long-term growth visibility as well as valuation comfort. So again, to cut short, near term, there would be pressure, but for someone who has patience, I would buy into these corrections as it would be good opportunity to buy into some of these good names.
Okay, all right. Hi, Sid. Morning. Good to see you. When since the globe looks to be in a bit of a tizzy, at least for the time being, with particularly with regard to the tech names, let's look inward. Let's look at the domestic-facing themes. What do you like out here? You've been positive in the past on cement as well as real estate. What views out there, and which are the stocks that you would look to buy?
Yeah, Nigel. Good morning. So cement, we had been positive, but if you look at last few months, there has been a price decline, and the channel suggests that price has been coming down about 1.5–2% on a month-on-month basis in Feb as well, and largely led by regions in East, South, and North regions. The only good part is that demand has been pretty strong and healthy. The other part is that with the election code of conduct now being set in, we expect some slowdown in terms of the infrastructure offtake, while the residential demand and the real estate demand for cement continues to be pretty strong. So again, a sector where I think 1 quarter of weakness could be seen, especially in the Q1 of FY25 because of the price cut and the rising crude oil prices, which has just started rising off in the last couple of weeks. So there would be some pressure in the cement pack. Nonetheless, we like Ultratech in the large cap space, which is the well-diversified player with a presence all across India and a very efficient operations. And within the mid-cap space, we like JK Cement. Similarly, if you talk about the real estate pack, I think things were looking very good, and they're reporting very strong numbers, record, you can say, bookings for most of the players. And we saw a stock run up as well in the past. And in the last few days, we have seen a good profit booking. So we believe that it's a good entry opportunity into the long-term story for real estate because things have not yet slowed down. And again, the US Fed talking about 3 rate cuts, RBI will follow suit, and that will also help improve demand in the mid segment. Right now, we are seeing a lot of strong demand from the premium and the luxury segment of the real estate market. So I think that would do well. We like a Prestige and Sobha. But if you look at a Brigade Enterprises is also entering into some of the non-focus regions, which should also help boost growth.
Got it. Siddharth, stay on. We'll have some more questions for you. By the way, just point out that the markets in China and Hong Kong, they are looking at big cuts now. The Hang Seng is down 2.5%. Mainland Chinese markets are lower. So generally, beyond Japan, actually even the Japanese market has cooled off quite a bit. So there's a bit of a profit-taking, risk-off kind of a sentiment playing out across Asia. But let's head across to Anuj to make sense of the kind of bounce that we had yesterday and what lies ahead. Anuj, good morning. So it was a good Thursday, but the question is, will the bulls get a good Friday also?
Well, morning, Surabhi. You know what? A lot depends on how the market will negotiate the weakness in IT, right? Today it's going to be all about IT versus others. And the reason for that is the Accenture cut. And it's not just the cut. The fact that FY24 revenue guidance has been cut to 1 to 3% from 2 to 5%. Keep in mind, Accenture's year-end is August 31. I think that's important to point out. So that means that at least for next 2 quarters, they're expecting pressure. And of course, Indian IT stocks are very positively correlated to IT. Having said that, yesterday the market, we spoke about the fact that it was a test of the market and the market passed it with distinction. Especially given the way the market bet was yesterday at about 5:1, and through the day it was very strong. I think that was the most important factor of yesterday's trade. And 21,900 was reclaimed after just 1 day of fall. That was another positive. Now 21,900 becomes line in sand once again. It should not breach it for a second time, because if that happens, then there could be problem. The bigger question is the mid-cap correction over? I think in that, maybe the one-way indiscriminate selling, that perhaps could have come to an end, but not every stock which has fallen 30 to 40% will reclaim its highs. From here on, you'll have to be very selective, because certain stocks will also fall maybe 10 to 20%, and certain stocks will give you big returns. So you'll have to make that distinction. Money making won't be as easy as it has been for last 1 year, where you could have bought anything and it would have given you money. Now, in terms of positioning in the index futures, FIs from 31%, they've gone to 33% long. But the only worry here in the setup is the India VIX and put call ratio. They have once again come into the complacent zone. India VIX is down 7% at 12.5, and put call ratio is at 1.2 versus 0.79. Let me come to levels now. On the Nifty, the short covering bit is over. Now the market needs cash for it to move from here. The support is 21,900 to 21,940. And then 21,700 to 21,800, the series low. On the upside, the first resistance is 22,081, yesterday's high, and then 22,150 to 22,200, which was the breakdown zone. I think it will take some doing for the Nifty to get past that. The bank Nifty, I think, is very crucial to watch today. A, because Nifty IT would be under pressure, so you'll focus on bank Nifty. It did not sustain about 10 and 20-day exponential moving average yesterday. Those are the levels to watch: 46,710 and 46,800 thereabout. So those are basically the levels to watch. As usual, I'll leave you with the thought for the day. It's the United Nations World Water Day today, and urgent appeal to everyone, especially in India, where the metros are struggling with water scarcity. That's the quote of the day. Thousands have lived without love, not one without water. So please conserve water.
Okay. Thanks a lot for that, Anuj. Important thought to live with today. Well, let's take a quick break on that note. On the other side of the break, Sudarshan Sukhani, Shrikant Chauhan will be joining in for some technical trades. Stay with us.
Welcome back. If you ask for a dip, you're going to get that one early this morning. But should you be buying into that? Well, Sudarshan joins in to help us out with exactly that. Hi, Sudarshan. Good morning. Well, yesterday we had a pretty good session, and we ended with good gains as well. Now, today we're likely to see a bit of a pullback, maybe a 50-point pullback, to kickstart rates, starting off at the back foot, and Asian markets are in a tizzy. At what stage will you be looking to buy into the Nifty, or do you think that you'll be looking at shorting on any kind of bounce?
Good morning. Well, today, at least for the Nifty, there is still a potential for buying. But we have to keep it intraday, because we have an extended weekend. And not just that, the markets can change on a dime, on the next day morning. So for the Nifty, the dip that if we see an expected 50-point dip from the closing price of yesterday, that's an opportunity where we go long for an intraday trade in the Nifty with a tight stop of 75 points. But it is possible that we'll get something out of it today. Unfortunately, the Bank Nifty created a lot of confusion on the charts yesterday. The outperformance went away. That yesterday was a disappointing day for the Bank Nifty. So the Bank Nifty is a complete avoid now.
The Bank Nifty is a complete avoid. Got that. What about individual stocks, Sudarshan? What are you looking at? And how does one approach IT now? Because in all probability, there will be a dip. Do you buy into IT names or do you stay away?
I think we would buy into IT names if we are taking a positional trade. These dips are meant to be, accumulating. They are designed for accumulation of good quality stocks. But for the trader who's looking for a trade today or on Tuesday, I don't think IT is a good idea. We just have to keep away from it. Tata Communications, as you talked about IT, Tata Communications is an intraday short, sell with a stop of 1994. HDFC Life has been an outperformer. That's a buying opportunity with a stop under 601. Similarly, Bharat Forge again is an underperformer. That's an intraday short with a stop above 1175. And finally, Maruti, which is making new highs for this uptrend, is a buying opportunity with a stop under 11,460. It's a mixed bag, but as you said, IT is an avoid.
Okay, got that, Sudarshan. Let's bring in Shrikant Chauhan into the conversation as well. Shrikant, morning. So give us your thoughts on the index, the Nifty, and also throw in a word on the bank Nifty, because everyone's wondering that if the IT guys fall today, which might just happen, whether banks can pick up the slack. So what is your takeaway from the Nifty bank? Just tell us about both of them.
Yeah, good morning, Surbi. Good morning, everyone. Yeah, I think for the Nifty and for the bank Nifty, I think both these indices are in the pullback mode. And especially Bank Nifty is finding a lot of resistance close to 47,000 levels. It has resistance of 20-day simple moving average, which most of the time acts as powerful resistance. But on the dismissal of that, we can expect a quick recovery towards 47,700 or maybe 48,000. Almost all the stocks, or I can say the contributors of the Bank Nifty, are showing good strength. So I'm expecting Bank Nifty to cross the level of 47,000 very soon. Today, if there is any correction, then it will be an opportunity for traders to take or to add some long positions with a stop loss at 46,200. So broadly, we are bullish on the Bank Nifty and we are expecting Bank Nifty to cross its previous high. For the Nifty, I think it is in the range, but it again, as it is in the pullback, about 22,080 we can expect bullishness up to 22,200.
And Shrikant, your stock picks as well, please.
Like when I was going through with stocks or specific sectors, then in that we saw some activity in real estate companies, realty space. In that, Brigade is very close to its important support levels. So risk-reward ratio is quite favorable at current levels for traders as well as for investors. It's a buy at current levels around 875, 880. With a target of 1,050, 1,060, we should look for adding this stock to the portfolio. We can keep stop loss around 840 for the same. And we also like few energy companies in that BPCL, Coal India, ONGC, all are showing some strength. But Coal India is showing a lot of strength as compared to other stocks in that particular space. Coal India is currently around 432. From here, again, the stock can jump to the levels of 460, 65. So it's a buy at current levels with a stop loss close to 420.
All right. Thanks a lot for that, Shrikant and Sudarshan. Well, Sneha Seth is also joining in. She's the derivatives research analyst at Angel One. Sneha, hi, good morning. This market has, clawed back to 22,000, but now looks like IT stocks could play a bit of a dampener. How are you approaching it and what are the stocks to look at?
Very good morning, Sonia. If you see, yes, yesterday's closing was quite interesting. In fact, I see that 21,800 has become an immediate support zone. With IV especially falling towards 12.5, it clearly indicates that overall there is a strength in market. Despite market was giving a profit taking, the IVs were quite stable, and now it has approached towards 12.5. So I think market for now 21,800 would be acting as a support, and on the higher side, it would be interesting to see if any follow-up move beyond 22,100, 22,200 zone. So if we see an up move beyond that, then only we may see some momentum coming in. Otherwise, index may consolidate in this range. Individual counters, there were many counters which has given a short covering move yesterday. Out of which two counters, which is a buy for me, is Apollo Tires. It has corrected decent, and it has been taking support around 440 odd zone. And now I think there can be a further short covering move in this counter. So I would recommend buying this counter with a strict stop loss of 447, and the target expected will be 480. Apart from this, BPCL, this counter also has corrected recently and has formed a strong base around 555 odd zone. So I think we may see a follow-up buying in this particular counter as well. So I would recommend buying this counter with a strict stop loss of 572, and the target expected will be 625.
Okay, all right, got that. Thank you very much for all of those trading calls. So there you have it, a couple of trades to work with on technicals as well as on the derivative side of the market. Let's take a break with the news that most of Asian markets are still cooling off, so likely to be a bit of a red start, and we'll see how it picks up from there. We'll come back, we'll have the pre-opening rates, and also we'll get a conversation going with Renu Baid Pogalia of IIFL Institutional Equities. We'll put the focus on the capital goods sector.
Welcome back. In about a couple of minutes from now, we'll get the pre-opening rates to kick in, and it doesn't look like it's going to be a good start. Down about 60 odd points on the GIFT Nifty implied opening. That's largely because of the IT stocks and the pressure that could bring about. Siddharth Khemka is still with us, so let's get straight to him. Siddharth, very interesting note from UBS on Reliance this morning, where they have raised the target price to 34.20, and they talk about how they are really bullish on the consumer-facing businesses. Is it a good time to be putting more money to work in Reliance?
Yeah, Sonia. So incidentally, we also put out a note yesterday on Reliance. What we are looking at that the company is turning into new energy, and that vision is now looking into more action. The Ministry of New and Renewable Energy has recently announced it plans to set up 2 hydrogen hubs in India by FY26. And also to provide incentives up to 44 billion rupees for electrolyzer manufacturing. And we are seeing that what Reliance is doing is that they plan to establish a large giga-scale electrolyzer manufacturing facility, which we believe is like focusing on the new energy. And this is the same reason why the street turned a bit negative, because these are large capital-intensive business, and the company which had become net debt-free some time back got into more debt. And now we are seeing that coming in, fructifying, and a lot more focus is into the green energy. If you look at the core business, the oil and chemicals, we believe that Q4 should remain robust given the sharp recovery in the Singapore GRMs, which currently is about $7.4 per barrel compared to Q3 of 5.5. And we believe that that should be positive. NAFTA as well as the petchem spreads are also stable Q on Q. And in the telecom business, we are seeing a 5% CAGR for subscribers as well as ARPU. And in the overall retail business, we are expecting for the next 2-3 years almost 29-30% EBITDA CAGR, led by store additions, higher store productivity, as well as foray into digital as well as new e-commerce businesses. So overall, I think it's a very good time to set your eyes into Reliance Industries. Market is also favoring the large caps. The valuations for Reliance is comfortable because it's not participated in the recent past. So we have a buy rating and a target price of 3,210, and definitely a very positive view on Reliance.
Okay, that's a positive call on Reliance. What is not so positive is the market's first reaction to IT, and that's a long expected line. So we started getting the pre-open rates. Let's pull up some of these stocks, HCL Tech, Wipro, Infosys, TCS. These are first reactions. Remember, this is pre-open, but the screen suggests that we could look at between a 2% to 3% dip, depending on whichever stock you're pointing out. The bigger question is whether Reliance, the stock that we were just discussing, whether RIL and the larger banks, whether they can come and pick up the tab. Right now, HDFC Bank is also nursing a bit of red. So it doesn't seem like it. We now have the first rate on the Nifty, the pre-open rate, and that's a 0.5% decline. So about 120-point cut is the kind of gap down that we can expect at open. So that's how it's playing out. Siddharth, just to wrap things up, I mean, when we started, you did mention that maybe these dips in IT could be a decent buying opportunity. So just expand on that a bit, because we were just speaking to an analyst earlier. The fear is that because of the reality that Accenture has put out there, maybe even Indian giants like Infosys will come out and scale down their FY25 guidance, and stocks have already moved higher. So despite the rally, what do you still like in IT?
Yeah, Surbi. So I think definitely there is a risk for further downgrade in the guidance by Infi, like the likes of Infi. So what we like within the IT is TCS. We believe it's a well diversified player, largest among the Indian IT companies, with presence across the segments. And given its size, we believe that it could continue to do well despite the weakness, near-term weakness. The second set that we like is the ERD businesses within the tier 2 players, where we are not seeing the kind of slowdown these IT services companies are witnessing. So within that, stock that we like is Cyient, where the order and deal wins have been pretty strong. The delivery has been pretty strong. And in terms of earnings growth, for the next 2-3 years, we are seeing about 25-30% earnings growth to be delivered. And on back of that, valuations are still not that premium compared to what the growths are. So Cyient is something that we like within the tier 2, the engineering and development focused companies. We have a target of 2,400 on Cyient, which is a good decent upside from current levels.
Okay, so got it. Cyient in the mid caps tier 2 and TCS in the large caps. Got that. Siddharth, thanks very much. Great having you on the show today. Have a good day and we look forward to our next conversation. Well, IT, of course, continues to remain in focus. But another sector on which we're putting the spotlight on this morning is the capital goods space. Of course, this is a sector that's been well loved by the market in the last 12 months. The question is, what do you do now? If you want to make fresh allocation, do capital goods stocks still make the cut? Now, in a recent note, IIFL Securities says that domestic execution was healthy in the third quarter and exports were a little soft because of global inventory destocking. So IIFL is actually still positive on quite a few capital goods stocks. To talk about this, we have Renu Pugalia, Senior Vice President Research at IIFL Institutional Equities. Renu, so that question to you, right? I think, good morning, first of all, thank you for joining in. I think the question that everyone's grappling with, there are a lot of capital goods stocks, they've given fantastic returns already. So the question is whether valuations still leave more on the table and whether this kind of growth that we have seen in the past, whether that can continue. Given that there's so much going on in the sector, there's energy transition, some companies like CG Power are going and setting up semiconductor assembly units, a lot happening. What should investors keep their eye on? Which stocks?
First, good morning, everyone. So I would say cap goods, the sector overall still has a lot of legs in terms of growth. First, if we look in terms of the large infra-led sectors, while it was railway, water, other infra driving, now the government has clearly expressed its intent to focus on the power sector reforms and bring back the investments in thermal power. Now, this has been one of the biggest driver of investments during the last cycle and the biggest link during the current cycle investments. So this will add longevity to the cycle in terms of capex and investments. Secondly, in terms of private sector investments, they're broadly holding up well, and new sectors are clearly emerging, like the electronics and semiconductor, which they did not exist in India, but OSAT in the next 2 years could be another $4 to $5 billion market for Indian companies here. So to that extent, we have seen the rally, or I would say the drivers being far more broad-based. So while we did mention that exports in the short term have seen some moderation, but it's more of a cyclical adjustments in global inventories and inflation impact in a lot of economies outside. But the domestic market remains very strong and resilient. And I think that will ensure that the growth momentum is broadly maintained even over the next 2 to 3 years as we move ahead. So while there will be some interim impact for a quarter or two during elections, I think that will be just more of a near-term adjustment. But the 2 to 3 year growth outlook in terms of earnings and revenue order book for across companies in the sector have been fairly strong. So that should help the companies and the valuations as well.
Got it. Renu, hi, good morning. So you mentioned OSAT, right? I just wanted to mention for the benefit of our viewers, that's outsourced semiconductor assembly and test. And now there are larger players like Intel, etc., getting into this space. I want to understand, what does this mean for a name like CG Power, which has been sitting at fresh 52-week highs day after day. Now it's announced its semiconductor foray as well. For someone who's missed the bus here, is there more to go on the upside?
I think from a stock perspective, the core business is reasonably priced, but the market is still trying to identify what value to be ascribed to the OSAT business. They've announced investments of almost $790 million. Business typically compared to other businesses is not very high asset turns. But the fact that government is given 50% capital subsidy from the central government, 25% from state government. So with nearly 75% capital subsidy, this business becomes fairly attractive in terms of ROCEs. And what will help value accretion is they have got the right technology partners in place. But this business will take about 2 to 3 years to come into shape, start operations, and then kickstart. So what it means for CG Power is a completely new diversified revenue stream, which is very different from their current industrial products business or the power products business. And this gives them an opportunity to play in the electronics value chain in the country and also be a small part of the global supply chain. So to that extent, I think the value of the OSAT business is not fully captured. And if we try and ascribe a value anywhere between 8 to 100 billion rupees for this, 80 to 100 billion rupees for this. So to that extent, I think there is still enough headroom for upside in the stock and name. So it becomes a good proxy play on core investments in the power sector through T&D play, through industrial short cycle, at the same time electronics value chain through the OSAT entry, which they have recently announced.
Okay, all right. Renu, good morning and good to see you again. I wanted your view on this entire transformer space. Plenty of interest out there. Could you tell us who is best placed according to you?
Difficult to answer. I think pointing out to one single player would be difficult. What I can outline is if you look at the demand-supply dynamics in the transformer sector, now has clearly tilted towards the equipment manufacturers, given the fact that Chinese players who were almost 30-35% of the market are out today. And in demand in terms of investments coming in from the private sector CAPEX, as well as from grid investments are coming back. So to that extent, I think the extra high voltage players who were struggling with massive demand supply mismatches earlier now are in a sweet spot. So there are 3-4 large companies in the listed space, be it GE T&D, Hitachi Energy, CG Power in this space. They will clearly benefit. And if we see the government going ahead with distribution reforms over the next 12-18 months, once they are back in power, then I think a whole bunch of medium and low voltage transformer companies would see significant step up, changes in regulations, rating. So I think the entire value chain, be it the medium low voltage space or the high voltage players, everybody will benefit. The industry was plagued with undercapacity and underinvestments over the last 5-7 years. And everybody, I think most of the companies have announced capacity expansion between 50% to 100%. And that, in my view, will just cater to the next 2.5-3 years. Companies will have to step up investments further if the entire power sector value chain really shows up in terms of investments in thermal power growth.
Renu, I guess your optimism shows up in your recommendations as well. You have either ads or buys across pretty much the entire sector, right? But help us out here in terms of perhaps the top 1 or 2 ideas. I mean, which are the best stocks to be in right now if someone's making fresh allocations?
On a relative scale, I would say, yes, if you look at some of the larger MNCs, they now look fairly priced. On a relative scale, we still like Cummins India, maybe CG Power, yes, from the new opportunities in OSAT, that also looks interesting. Bharat Electronics continues to be among our top picks in the overall sector, given strong legs of investments coming in the defense space and the order backlog. Otherwise, I would say some of the other larger names like L&T, which has been among our favorite picks, they look reasonably priced at current level. Same goes for Siemens, ABB. So to that extent, the top 3 picks adjusted for valuation, etc. I think after the recent correction and play on cap goods for us would be Bharat Electronics, Cummins, and CG Power can also be looked from a longer term perspective.
All right, Renu, we'll leave it at that.
Nothing is cheap in the cap goods sector. Everything is expensive.
Yeah. Well, guess what? Nothing is cheap in this market anymore, right? So we've got to live with that and just perhaps identify growth stocks and nothing too much on valuations. But of course, keeping valuations in mind, as you said. But thanks a lot for joining in. Appreciate your time here and very, very helpful discussion over there on the capital goods space. But for the market, looks like it's going to be a weak start. 80 points lower on the Nifty. The sensex is down about 400 points. And all your top losers are, surprise, IT stocks. I mean, no surprises there, to be honest. HCL Tech, Wipro, LTI, Mindtree, Infosys, TCS, all down about 2 to 2.5%. But Sonal is joining in. She's going to give us a bull versus bear case on OMCs, which have, been in the news lately. Sonal, over to you.
Thank you for that. Well, crude oil prices, they are the tipping point now.
around that $88 per barrel mark. And CLSA, they continue to reiterate the bear case here. They reiterate their sell because they say $88 per barrel is the break-even point for their marketing margins. So if crude prices go above that, marketing margins could turn negative for the company. So they say it could turn negative for IOC, BPCL and HPCL ultimately, which is negative for these companies. Given upcoming elections as well, there is no price hike which is likely, the retail price hike that is, that would mean they will continue to be under stress as well. They reiterate a sell on all the three oil marketing companies. Nomura, on the other hand, has upgraded HPCL. The target price is raised to 570 and IOC is also upgraded to a buy. They are reiterating their buy on BPCL and have raised the target price there. They are saying marketing overhang is complete now with the price cuts that came by. Refining outlook remains healthy. They are building in refining margins of $9 per barrel for the two financial years coming up. Investments in refining and favorable crude sourcing have led to OMCs seeing a premium versus Singapore GRMs right now. And they are saying that this is something which could be positive for all these companies, and they continue to remain positive.
Always a great fight between the bulls and the bears on oil marketing companies, right? Thanks for that, Sonal. Back to Rima. Rima, we said it's going to be all eyes on you today. So IT stocks very much in focus. Just tell us, what the major views are on the street now after this Accenture guidance cut.
Let me start with CLSA, where they say that the sharp downward revision in Accenture's guidance implies there is no recovery in the second half of the year, which ties in with CLSA's own channel checks and the commentary from the Indian management. So they maintain a cautious stance on IT. They believe the IT sector is still in an earnings downgrade cycle, which is not reflected in the valuations. They have a sell call on Wipro, HCL, TCS and LTIMindtree. Morgan Stanley too says Accenture's cut in its guidance has raised concerns about the pace of recovery. If you remember, the market is penciling in a recovery in IT growth in FY25. Now that pace, the extent of recovery is now going to come under question, and therefore even Morgan Stanley believes FY25 consensus revenue forecasts are now at risk. Nomura believes it's time to be selective on the Indian IT space because discretionary revival is still some time away. They have a buy call on Tech Mahindra in large caps, on Coforge, Birlasoft and eClerx in the mid-cap space, but they have a reduced call on TCS, Wipro, LTIMindtree, L&T Tech and Mphasis. Back to you.
All right, thanks a lot for that. I'm also going to watch out for one stock, Eicher Motors, which is the biggest weekly gainer. This week, Eicher Motors is up almost about 5.5%, and it's now hit that 1 lakh crore mark in terms of market cap. Yeah. So we were talking about how the valuations of Eicher are much more attractive compared to its peers like, say, a Bajaj Auto or a Hero MotoCorp. And that's the biggest weekly gainer. Perhaps today there could be some more follow-on.
Just one more stock, Sonia. Shriram Finance. In the pre-open, we had a large trade that took place. Yesterday, the stock was underperforming. Maybe to get this block out of the way. It's out of the way. It comes into the Nifty in the next few days. And there are a couple of upgrades on that stock as well. So I'll keep an eye out on Shriram Finance.
Well, okay, we've got the bell going off. So let's just, start it off. So the first green tick is actually on the bank Nifty. It's not much, it was 5 points up. But now it's already cooled off. It's fallen down. If we talk about the Nifty, let's get the big reactions out of the way. So Wipro 3%, Mphasis down 3%, Tech Mahindra is down about 2.5%, LTIMindtree about 3%, HCL Tech TCS. I mean, this is a very expected first trade down. The question is whether buyers come in or whether IT remains a no-go zone. So let's talk about the counterweights. On the upside of the screen, you've got Bharti Airtel lending some support. You have HUL and ITC batting. And in terms of banking, Axis Bank is seeing some green, but HDFC Bank is very flat. It's not really helping the bulls case too much. ICICI Bank is up about 0.25%. So interesting, banks are not too bad. They're trying to offer some sort of a counter to IT, as is Reliance. This is exactly what Nigel and I were discussing earlier, whether banks and Reliance can offer the counter. And as of now, the answer is yes.
All right. Let me just take it to some of the individual stocks. As you pointed out, the IT stocks are the ones that are really under pressure as we speak. So all your IT names are down anywhere between 2 to 3% odd. The Nifty IT index itself is down almost about 3% odd. So not looking great over there. And then you have names like Wipro, Tech Mahindra, TCS that are all under pressure as we speak. Keep an eye out on them. Remember, Accenture has lowered their guidance to 1 to 3% from 2 to 5% for FY24. The other stock I'm looking at is Texmaco Rail. It launched a QIP last evening, so that definitely will be in focus this morning as well. Let's get Texmaco Rail on the screen. The stock is up almost about 2% odd. Prestige Estates has acquired 62 acres in the NCR region. They've bought this land for 468 crores. That's the big mover in the broader market. Just look at that, 5.5% higher on Prestige Estates as their expansion continues both in the Mumbai as well as the NCR region. Karnataka Bank sources indicate that they will be raising up to 600 crores via the QIP route. The floor price is at 231 rupees, so keep an eye out on Karnataka Bank, up about 1%. Then you have Tata Communications. They are looking to sell their digital services business to the wholly owned subsidiary for 458 crores. So Tatacom up almost about 0.5%. Some very interesting brokerages this morning. There is Amber Enterprises, where CLSA has upgraded Amber Enterprises to a buy. They've raised their target price to 4,300 on the stock. So that one is up about 2% reacting to that news flow. And then you have Reliance Industries, where UBS has maintained a buy. The price target has been raised to 34.20 on Reliance Industries. They are very, very bullish on the consumer business. So Reliance Industries is up almost about 0.1%. But overall, on the index itself, the Nifty is down about 50 odd points, similar to what the GIFT Nifty suggested, dragged down lower by the Nifty IT index. Otherwise, it's the banks that are really making sure that, the Nifty stays afloat at least around the 21,900 mark. Back to you.
All right. Well, thanks a lot for that, Sonia. A few stocks that are, deserve special mention. I think these tech-related names, particularly mid-cap IT, is taking it hard. And, they're the top volume movers today. Birlasoft, Persistent Systems, Emphasis, and Coforge. From the F&O stocks, these are the top losers. So all of them should come up for you on the screen. What's doing well then? Indus Stars, the street is waiting for that large trade. It hasn't really taken place, and now the shorts seem to be scampering for cover. That stock is one of the top gainers in the F&O market, so that's up close to 2%. Union Bank as well as another name that's moving quite well, so that stock as well has moved up in today's trading session. IRIDA saw a sharp correction from around 220 rupees, if I'm not mistaken, all the way to around 125. Today, that's one of the top volume movers, up close to around 2.5% in trade today. And, a couple of other notable movers. I think we have Central Bank of India as well, that's moving higher. Geo Financial Services corrected a little bit after the big run. Well, that's pulling back, and it's pulling back on rather large volumes. So one would have to say that the Nifty Bank is putting in its best foot forward as we speak, because that's the lone index that's trading in the green as the IT-related names are struggling. But should be the mid-cap index. Well, that's doing a relative outperformance. You like that? Two stocks advancing for one stock that's declining.
I take your point, absolutely, Nigel. But the thing is, we don't have any outlier movers immediately. Even the reactions to a lot of the news flow, commentary, brokerage reports, it's not exactly popping. But let's see, it's very, very early on. It's only even 1 or 2 minutes into the opening. We'll see how this develops. Right now, the market's digesting that IT blow. Well, let's move on and welcome our next guest on the show. Lawrence Belanco from CLSA is joining in. Good to get some perspective now, considering all that this market has gone through over the last couple of weeks. Lawrence, great to have you. Thank you very much and good morning to you. So, the Indian market has had its first bout of a mini correction, so to speak, particularly the mid caps and the small caps, though the headline index hasn't lost too much from the top. What do you make of things as they stand here in India right now? How are you reading the charts?
Yeah, so definitely running through the first meaningful correction that we've had since September last year. And we don't think this corrective action's over. We expect sort of volatility to pick up and ultimately both the mid-cap index and the Nifty itself to correct back to its 200-day. What that would mean in relative terms is that Nifty's got roughly 5% downside, but the mid-cap index from current levels still has roughly 10% downside. So we think there is still some relative underperformance, further volatility in mid-caps, while you get some relative outperformance from the large cap side. But both indices running through this correction should ultimately see a test of the 200-day. That's a longer-term trend. It doesn't break that structure, but definitely in the short term, expect more volatility.
Well, just a couple of more stocks that I want to mention. One of them is Metro Brands. And, there is a very interesting note that we've got on Metro Brands from Goldman Sachs this morning. So do keep an eye out on that. They've initiated coverage on Metro Brands and on Bata India. Metro Brands, in fact, is now up almost about 6% odd. They have a buy on Metro Goldman Sachs with a target price of 14.50, which is well above the current market price. And on Bata, they have a neutral with a target price of 14.70. So Metro Brands is a big mover this morning. Lawrence, hi, good morning, and thanks for joining in. So, just to get some targets out of the way before we move on to other big technical trends, on the Nifty itself, do you think this 22,000 mark is something that could be a struggle for a while? And by the end of this calendar year, what are you looking at as both the floor and the ceiling for this market?
Yeah, so I mean, our base case is that this current correction unfolds down to the 200-day moving average, and that's basically around the 20,200. It will be slightly grinding higher even if we run through this correction. So we're looking at about 20,200 to 20,300. So that's where we think the floor would be, and a bit of time consolidating around that level. But like I said earlier, it doesn't break that longer-term uptrend, and we still got targets sitting around the 23,000 area. So once we run through this correction, longer-term uptrend should resume, and then we're targeting moves closer to that 23,000 area.
All right. Hi, Lawrence. Good to see you in, and thanks so much for joining in. So maybe a pullback to the 200 DMA, and then, in fact, we bounce off there on the Nifty. The sector that's in focus this morning, post that weak guidance coming from Accenture overnight, is the IT index. And you believe that it's breaking down a little bit? Tell us the levels we should track on the Nifty IT index.
Yeah, absolutely. So if you look at that Nifty IT index, it's quite interesting that the recovery rally that you've seen from October lows last year has got basically back to the 2021 highs. That's where we've stalled and rolled over. And to use the sort of chart terminology, you've got this classic head and shoulders top that we broke down from this week. And that gives you roughly 7% downside from current levels. And it does make the IT sector a relative underperformer, particularly if you look at it versus the banking sector or the broader Nifty index. So, what takes the broader Nifty down to its 200-day is essentially the weight from the IT sector. So if you look at Infosys, Tata Consulting, all quite similar topping patterns and breakdowns that you've seen from that.
So, just to complete the point on the Indian market before we move on, Lawrence, since you are expecting a bit more of a correction to play out, and 5% index level, 10% mid caps can be, even more brutal for individual stocks. Any advice you'd want to put out there? What should portfolio shifts be like? Would you say some rotation into maybe a Reliance, or I don't know? I mean, if the bank index is looking better off.
Yeah. So I mean, obviously through this corrective phase, it's all about relative outperformance. So something falling less, or at least holding its ground. And yes, Reliance does stand out. If you remember that the stock broke out of a 2-year trading range, that you've still got longer-term upside targets of 34,000 to 35,500. And this current pullback that you've seen between 2,600 and 2,800 would be, I think, an opportunity to add exposure there. And with that limited downside, it should give you relative outperformance. Within the banking space, I think there's sort of rotation opportunities. Essentially we're having a high momentum correction or a crowded positioning correction. And that's why you've seen the mid caps fall more. And if you look at the banking side, that's why you've seen the state banks fall more than the private bank. So as a relative trade, RCRCI looks like it should outperform State Bank of India. So there's some tactical rotation there. And if you stick with the private banks, I think, again, RCRCI is a long and Axis Bank as a short. There's some weakness on that Axis Bank chart too that we've seen there. So again, selectively, there's stocks, I think, that you can remain long that hold their ground, but there's some stocks that still look vulnerable to further downside. But the message should be stick to the larger cap names through this corrective phase.
Okay, stick to the larger cap names through this corrective phase. Got that. That's an important message. How are you feeling about the global markets now? Because most markets, whether it's the Dow, the S&P 500, even the Nikkei for that matter, are sitting at fresh record highs. Is there more steam to this rally there? And if yes, what are the levels to watch?
Yeah, I think the interesting setup that we're looking at in the US is actually the reemergence of the small cap index post the Fed meeting this week. And we had corrected back to the 50-day before the Fed meeting. We've actually bounced off that. And if you look at, take the extreme of Russell 2000 versus NASDAQ 100, is the relative chart of those two indices have seen small caps actually bottom out in February and outperform. So technically, the upside potential is greater in the small cap space, even with the NASDAQ being in a very well-defined uptrend channel. You can look at some of the mega cap tech stocks like Apple, which is really stalled out, and the $166, $167 area is quite critical for Apple. So if that does break down, that can be a drag on the NASDAQ 100, where you've got this potential re-rating in the Russell 2000. And I think, regionally, one of the issues that India has run into the near term has been its great outperformance. What you're seeing currently with markets like Korea breaking out, some stability in China, is that investors, for a change, have a bit of alternate destinations to look at, because India had been such a dominant outperformer throughout last year. And as we've gone through this year, we've started to see other markets which have lagged started to break out. And Korea is one of those markets that stand out that has got investors' attention and taken away a bit from the India side.
All right, Lawrence, just to confirm, the tech index, that's completed a 10% correction from the 52-week high, currently holding around 34,800. The level that you said it will correct to is closer to around 33,000. If you could just help us out with that level.
Yeah, absolutely. So another 7% downside risk. So, it'll take you to almost a 20% correction from that 52-week high that we registered recently.
Got it. All right. Let's talk about one asset class that's been doing quite well. Part of the metal index. Let's focus on precious metals first. Gold has been doing well, and all that glitters actually has been gold, of late. Either which ways, if you look at the central bank action, prior to that, there were select central banks that were tanking up on gold. And that gave you a sense that maybe gold will bounce back, as does you had the equity markets that were overheated. What's the levels you're looking at on gold? And if there are any plays with regard to the stock market, whether it's looking at the gold NBFCs, gold, financial lenders here or Titan, any stocks that you could relate to it?
Yeah, I mean, on the gold side, absolutely a meaningful breakout once we finally cleared through that 2100 area. It had been a ceiling for gold price action since August 2020, so the breakout is meaningful. And from that trading range, we get an ultimate upside target of 2,500 to 2,550. Focus more on the gold miners, so I won't give any comments on the sort of derivative plays from a stock-specific basis, but absolutely, gold, we think there's still further to go with this breakout, and 2,500 to 2,550 being the upside target.
Okay, so gold still shining bright, huh? Lawrence, finally, so just how do you see things? Because of all the central bank talk, suddenly there was excitement in equity markets, but bond markets are not showing that level of an excitement. I mean, there's been no massive fall in the US 10-year. It's still about 4.2, 4.3. So how do you sort of read that whole situation, the dollar, the US 10-year, and what US equity markets are doing?
Yeah, so good question in that. Yield's quite interesting. As long as we remain stable here, and the key level that we're looking at on the upside is this 4.33 to 4.36. So as long as the 10-year yield stays below that level, we think equity markets can still work. But the key thing is the rotation that we've seen beneath the surface. I think the risk for global equities is if we did see a break above that 4.36% area on the 10-year yield, and we see acceleration in yields to the upside, that could be more of a concern for risk assets globally, and we get then more of a synchronized sell-off in equity markets. So we're watching that closely. Our base case is that we remain range-bound, and having a stable to range-bounding US bond market gives the opportunity for various parts of equities to work with a bit of rotation beneath the surface. The dollar setup is quite interesting. From a longer term side, we think the September 2022 high is a major cycle peak for the dollar. Over the past 12 months, we've been stuck in a range between 100 and 107. Now, we think that range ultimately sets the platform for another leg to the downside. But clearly right now we're sitting in the middle of that range. So quite trendless. But I think both having the 10-year yield as well as the dollar in a trading range lets equity markets breathe and have that rotation opportunity. You don't want these big macro markets trending in any meaningful manner that it starts to dislocate risk assets globally.
Okay, one final question from my end. Do you track the auto index? Because that has been one space that has really been on a tear in the last 6 to 12 months. Any more upsides that you see there in some of the top tier auto names?
Yeah, I mean, it's quite interesting. At the stock level, again, it's getting sort of quite selective. You've had things like Asian Motors roll over, Leland also roll over, but then you had Mahindra with momentum confirming its highs with Maruti Suzuki. So we think you need to get more selective at the end of the day. And then from the index level, what that means is that we're likely to go into a holding pattern and a trading range. That's relative to what we think the Nifty still corrects to, is that we're likely to see some outperformance from the broader auto space versus the Nifty, because the Nifty downside is really driven by that weakness and breakdown in the IT sector.
All right, Lawrence, a pleasure speaking to you. Thank you so much for joining us and taking the time out today. Have a great weekend. That is CLSA talking about the markets. But the big headline this morning is Accenture going and cutting their guidance for the full year, talking about outsourcing that could see a mid-single-digit growth. So there's quite amount of caution in their voice. Let's find out what is the read-through for other IT companies. Happiest Mind Technologies is the first management joining us on the show. The company also recently revamped its organization structure. There's a new vertical organization structure comprising 6 new industry groups. So we have Venkatraman Narayanan, the managing director and CFO of Happiest Mind Technologies, joining us now. Venkatraman, thanks a lot for joining in. Before I ask you about your own, business, I wanted your thoughts on the commentary that came in from Accenture, not just about them cutting their guidance, but also talking about how outsourcing will see a mid-single-digit growth going forward. Is that your assessment as well about a reduction in client spends, about, weakness in terms of outsourcing? What is your own expectation as we move along?
My personal view on this is, process to process. So it's as each company views it based on their customer and the prospect base that they are chasing right now. Accenture at such a big size, they are doing 16 billion a quarter. For them, a difference of a percentage is as much as many happiest minds, to just give you a case. So what I'm trying to say is there is something which is environment related, something which can be company specific, and something which is basis their current customers and the prospects that they have, or the channels that they are pursuing for business today. So which is what could explain maybe the 1 or 2% differences that they are talking about. As far as happiest minds is concerned, we've been talking about holding on to our guidance. We said 12 to 13%. We did adjust that in the early part of the year, and we are holding on to that. The last 3 quarters, we have met the guidance numbers on our growth and also on our EBITDA.
Okay, so you will hold on to your guidance for the full year for FY24. Do you think for FY25, will it be similar to the organic guidance that you've seen in FY24 of around 10 to 12%?
That's what we are expecting, but I don't want to say anything on that front unless we get the numbers put together. Right now, we are going through our annual plan session. So we are putting all of the numbers together. We are seeing decent sign-ups happening. And as you know, we have signed up about 40 new clients last year. There are existing projects which are also ramping up, despite the prioritization that's happened over the year. So we're putting all of this together, and we'll be back to you once we look at the numbers and we run it past our board, and we have those numbers which can be shared with the external world.
All right. Hi, good morning, Mr. Narayan, and good to see you in. Nigel on this side. Well, tell us more about this organizational changes that you've made, moving to vertical structure. How does it help you all in terms of growth? And also, I think you'll be focusing on the revenue per customer scaling up. If I look at the trend, a couple of years or so ago, it was 600,000, which moved to around 800,000 odd. And you all had guided that it moves to around 1 million USD per customer. Does it help that?
Absolutely. The idea is to, our goal is to reach $1 billion by 2031, which if you do a back of the envelope calculation, but we have done, so some amount of simulation, it says that you will have to have about 600 customers with about $1.5 million of revenue per customer, which would mean that we touch that goal of $1 billion plus. So if you have to work towards that goal, you need to make sure that you go deeper into your existing set from 808,000 of an average revenue. We have to touch those million and then slowly ramp it up to $1.5 million. We're talking about averages here. So you have some certain large customers, certain mid-sized customers, and it's all a mix which leads to this number of 1.5 million. So having just a salesperson and maybe the vertical people until now who acted more as pre-sales support, you today have something like a two-in-a-box. So you have the sales structure and alongside the verticalized organization. Both of them going into the customer with a lot more of domain pull, domain experience, and domain-led consulting, which only lets you go deeper into the customer. And all of that means you're targeting and you're trying to make the job of touching the $1.5 million or whatever that number that we are targeting for that much easier and achievable. Earlier, the sales, which was led a lot by technology, and then you had the verticals and the domain following through. Today, you have both of them in the front end, and both of them are talking technology, both of them are talking possibilities that we happiest minds have to offer them around the business that they are.
All right, so I just wondered that timeline. By when do you hit this $1 million per client mark? The timeline?
No, I said 1.5 million is the number that we should be targeting. That is by 2031. So
correct.
808 today, and slowly we are taking baby steps. And it all dovetails to the growth of the company. They grow at about 20% CAGR. You bring in that through acquisitions, you bring in that through organic growth, and all of this lead to that averages that we're talking about.
Okay.
It's a course that we have set for ourselves.
So 1.5 million per client by 2031. So that's a long-term roadmap that you've set out for yourself. Got that, Venkat? You know, just to go back to this issue about the immediate environment and what clients are saying. Now, Accenture, basically said that the delays are being seen in, more in short-term deals. Now, you're a company that's been born digital, and also you're taking this whole sort of strategic, change in terms of going vertically down in terms of sectors now. At the same time, there's so much happening on Gen AI, so there's so much going on. Can you elaborate a bit more? You're saying top-line growth will still perhaps be 10 to 12%. But really, what do all these changes mean in the near term, in the next couple of quarters? Will we see sort of straight-line growth, or can it get extremely choppy?
I again say this is all customer specific and company specific. So as I speak, each company has its own set of customers, and which is why you see divergence in these numbers versus Accenture versus Wipro and Infosys and the many mid-sized, small-sized companies around here. So you have to. There is an industry trend. There is a macro environment issue, because if you look at the commentary on Accenture, they're talking about interest rates and how that's hitting the economy, and which in turn is talking, flowing into capital formation and the way spends are happening. Asks of ROC, which are coming from the finance teams on new spends. Return on investment is being asked for nowadays. So these are all things which happen when there are tight economic and monetary situations. But also one has to weigh this in comparison to the programs or the project size that we are talking about. A multi-billion, multi-year program obviously gets challenged on these fronts or questioned on these fronts. But we are talking about continuing to build what you have in place. If you slip on your technology spend, you get set back by a couple of years. So when these questions come up, which is on your existing platforms, existing technology, people immediately continue to spend rather than wait for the things on the interest rates to change and those kind of things. So you've got a macro environment issue, and you've got a company specific issue. So you have to balance both of them. Accenture commentary I see as a industry and environment related point that they have made. Very valid point. We are also seeing that, which is why we recast our guidance, which was 25%, including inorganic growth, to where we are today of 12 to 13%, because there was inorganic did not happen, and there was a little bit of an adjustment in the organic part, given the way the business has built out over the last year.
Yeah, I just wanted to actually clarify that point. The 10 to 12% you're saying is organic. Is inorganic? Yeah, is inorganic still on the table? Just throw some light also. I mean, in terms of if you look at inorganic, what sectors will you target? What kind of companies? EdTech was a bit of a weak spot in the previous quarter for you as well. So just maybe some more color on sectors and the M&A opportunities that you will consider.
So the M&A opportunities are 100% digital, profitable companies. We are not in the business of turning around companies. All of that has been made public. Now with this verticalization, it just sets the ground that much better for integration. When we acquire a company, most companies which are of a certain size have certain capabilities which are around verticals. So you're able to plug that nicely into our organization, which is more verticalized right now. We are also making investments in generative AI inside our own company. We have started a new business unit on generative AI. So these acquired companies will bring us customers. They bring in capabilities. We are then able to cross-sell, upsell quite a few of our capabilities like security, analytics, AI, and generative AI into those companies. So these are all the aspects that we look at when we are looking at M&A. Talking about M&A for the current year, we've got only a few days left, and I'm not sure if we are going to be able to. I don't think we have anything which will change things for the current year, but for the next year, obviously, the pipeline is good. And we are continuously in dialogue with prospects and possible candidates.
Sure. Anything in this calendar year? Anything in this calendar year that we can expect? on the M&A front?
Yeah, absolutely. Absolutely. That's the idea, because we've been talking about this, we've raised capital, and we are working very hard on that.
Got it. We'll wait by for more details on that. Just one final question on EdTech, because, a lot of companies have been speaking about how EdTech growth has been under pressure. In fact, HDFC put out a note where they said that EdTech will decelerate in FY25. What is the kind of pressure that you are witnessing in this segment?
Just a clarification on our EdTech business. Our EdTech business is almost 100% US, UK, and focused outside India. So we don't have anything within India. So to that extent, the HDFC comment, I'm not able to correlate completely with our performance. In absolute number terms, EdTech has grown year over year for us as well. It's only in percentages that you will see those differences, because there are the manufacturing, and manufacturing has done very well. So has healthcare. Healthcare came up from nowhere. We were at about 7%, and today it is at 14% and growing. So it's on a comparative basis. EdTech shows a shrink, but not in absolute terms. Our EdTech is focused on the US. So there are three segments. One is school education up to K-12. Then you've got college education, and then you've got continuing professional education. These are all areas where we are seeing quite a bit of investment happening. A lot of new technologies being brought to the fore, including generative AI, and we are plugged into that well. And finally, at 23-24% of our business from EdTech, we are today positioned very well amongst prospects and customers. Whenever there is a talk of technology that's required for an EdTech customer, they do. Most probably, we'll get a call to present our capabilities.
All right, we'll let you go on that note. Thank you for answering all our questions with so much patience and giving us a lot of information about the business as well. $1 billion of revenues by 2031. They continue to stick to that guidance, and they give us a lot more details on the business. Let's step into a quick break. On the other side of the break, Jairam Sampath of Kaynes Technology India will be joining in to talk about their subsidiary Kaynes Semicon signing an agreement with ISO Tech to set up a center and supply chain for the OSAT business in India, which has become the big buzzword. Stay tuned for more on that.
Welcome back. Well, I just want to pull up two indices. You pull up the tech index and you pull up the Nifty Bank, and you'll just see that both of them are moving in the opposite direction. So if, so to call it, with IPL kick-starting today, if one batsman's not performing too well, the other one needs to step up. And I think that's precisely what's happening. And you have the Nifty Bank that's up close to around 100 points, while the tech index is tracking. Well, let's move on to the next management then. Kaynes Technology, the stock has surged close to around 180% in the past year. The company recently Kaynes Semicon, which is a wholly owned subsidiary of Kaynes Technology, signed a binding technology provision agreement with ISO Technology. This deal will enable Kaynes Semicon to set up a center and supply chain for OSAT business in India. Discuss this and more, we have Mr. Jairam Sampath, the director and the CFO of the company, who joins us on the show. Hi, Mr. Sampath. Good morning, and congratulations on this signing that you've done. Tell us more about this, though. You've recently entered into the TPA with the ISO Technology for developing OSAT in India. Tell us about this long-term scaling up plans that you have about this. What kind of an opportunity does it present, and how much can Kaynes Technology's subsidiary garner from that?
Yeah, good morning, Nigel. Thank you for having me on the show. So this process started more than 6 months ago when we contemplated on setting up a semiconductor assembly unit in India. This is part of our long-term objective of becoming an integrated EMS player. So it's our belief that over time, the electronics footprint will shrink and a lot of components will get into a wafer form. And then, of course, companies which have ability to convert those wafers into a chip would have some value addition. And also, in the process of shrinking of this electronics, there will be micro miniaturization of circuitry, which leads to high-density interconnection. And that's why we've also announced our project for high-density interconnection PCB fabrication. In some sense, you can say, in an approximate way, this is a backward integration. So we have tied up with this company. So this is the first step for the company as well as for the country, I think. we don't have too many OSAT facilities in India. So being the first step, we have tied up with a company which has necessary skills in the legacy packaging area too, and also they have some boutique customers. So this company is from Malaysia. The parent company of this ISO Tech is Brokerage. And after a lot of discussions...
Mr. Sampath?
Yes.
Mr. Sampath, most of these details with regard to this technology partner that you have tied up with, we have that. And congratulations on that. It's a step in the right direction and it'll help you all in backward integration, as you briefly mentioned. Give us a few data points. Okay, how much of money will you be investing? Point number one. By when do we see some kind of revenues coming out? If you could give us a brief asset turnover. And also some media reports suggest that the OSAT plant could be moving from Telangana to Gujarat. Clarify on that as well. Please go ahead.
No, absolutely, Major. Yeah. So thank you for kind of shortening my introduction there, and I can just get straight to the point now. In this entire semiconductor assembly business, the total currently we contemplate total capex of about 4,000 crores. Of course, this is supported by the government incentives, both central government, which is at 50% of the capex, and state governments is about 25% of the capex. Having said that, this is structured into a few phases. The original intent was to do 2 phases, wherein first phase will be we work with somebody like a partnership with ISO Tech, which is a subsidiary of Brokerage, and we develop our capabilities in the legacy areas. And then, of course, we quickly transform the company into a little more advanced packaging and so on. Because our objective is that at the end of the capex implementation of 4,000 crores, we should also be, bulk of our business should come from advanced packaging areas. And that would make this entire business more viable, even if the government subsidies were to be withdrawn at a later date. Now, having said that, this is a business which is capex intensive. And the asset turns in this business hover around 1 to 1.5 times. And obviously, there are different types of semiconductors that you can package and different types of packaging. And we start with legacy packaging, which is a tad, let's say, lesser in terms of its margins. And then quickly we move on to advanced packaging, which are very high margin activities. And we expect that by FY26 second half, we start getting revenue streams at about 40% utilization. And by FY28, the phase 1, which is roughly between 1,000 and 1,500 crores of capex, would start yielding revenues at about 80% utilization. That will be somewhere around 1,500 crores of revenues in this semicon alone. And then by FY30, the second phase, subsequent phases will also come in. And then by that time, will probably the semicon revenues for the company will be about 4,000 crores. And we have been working to improve our prospects, especially in the advanced packaging areas. We started with ISO Tech. And then later on, of course, we have tied up with a company called Aptos, and then there's a Japanese company with whom we have...
Sure. So, Mr. Sampath, lots of details there. Let me just sort of go over it. What you're saying is that the investment going up to FY28 should be about 1,000 to 1,500 crores. And by FY28, you're hoping to do similar revenues with a scale up to 4,000 crores, if I got you right.
Yes, you're right.
Okay, so just also give us a sense, let's say at least by FY28, when the first amount of this revenue trickles in, what's the larger game plan? Because right now, the bulk of your revenue is coming in from automotive. Last quarter, aerospace was very good. You've been telling us that, aerospace is a huge area of opportunity as well. So how much will semiconductors chip in? What's the revenue mix that you will target over the next 3 years?
Yeah, so if you fast forward to FY28, I expect the new streams of business, which is semiconductor assembly as well as the PC board businesses, would probably account for more than 20-25% of our total revenues. Okay, this is based on our estimates for the EMS business. And being capital intensive business, the growth in these businesses will not be as fast as the growth that you see in the EMS business. So we expect EMS businesses to still grow even in FY28 at 40-50%, and maybe these businesses will grow at 25-30% because these businesses will grow along with capacity augmentation, which we have to get our act together to make sure that we are able to invest into these businesses by, let's say, FY30. We should be able to generate cash, operating cash flows to justify investment back into this business, which we are thinking that is possible with all the steps that we have taken.
Got it. So your revenue potential earlier, you had spoken about a range of 1,500 to 2,000 crores in the next 3 to 4 years. Is that something you hold on to? And the two largest part of your businesses come from automotive, which is 30%, and industrials and EV, which is 44%. So will that continue to be the contribution going forward?
Yeah, going forward, see, FY24 is almost done deal. We have a couple of weeks left to complete FY24. In FY25, we expect slightly higher revenues in terms of proportions in the area of industrial, which is driven by smart meters, and also in the area of, that is, industrials and EV. We also expect railway signaling to contribute a tad more than what it has contributed in the past, that is FY24. And also in aerospace, outer space and strategic electronics also we expect significantly higher share. Also in the IT, especially high performance computing servers, we also expect. So essentially FY25 is going to be back to basics for us in terms of those areas which typically we have been doing well in the past up to years up to leading FY23. And we get back our, let's say, due share of business in those areas which are more complex and lower volume and high margin businesses.
Okay. All right, Mr. Sampath, got it. Thank you for joining in. I look forward to a longer conversation about, the immediate business, the here and now, perhaps the next time. But semiconductors is definitely an interesting space for the market as well. Moving on, Garden Reach Shipbuilders is the next stock and the next company on our radar. Now, the company recently entered into a contract with the Indian Register of Shipping for the development of green energy and autonomous vessels. To talk about this, we have with us Mr. P.R. Hari, Chairman and Managing Director of Garden Reach Shipbuilders. Thanks, Mr. Hari, for joining in. Great to have you on the show, sir. So, just put this in context. Green energy and autonomous vessels, it's all about going green across industries, right? So why should shipping be any different, I guess? Just tell us what it entails and, how does it play in with your order book? Your target for this financial year, FY24, was, I think, 24,000 crores in terms of order book. So are you going to be exceeding that? Question number one. And question two, how will this whole green energy vessels, how will they add to your order booking as we look at the next financial year?
Thank you, Surabhi. And before I answer your question, for 7 quarters on the trot, our financial performance has been on an upward trend. And specifically for the 9-month ending 31st December 2023, both the revenue from operations and the profit after tax have been the highest in the history of the company. As a matter of fact, 2,577 crores that our revenue from operations and 245 crores our profit after tax have already surpassed what we achieved during the full financial year FY23. Now coming to your specific questions, one on the order book status and linked to that the green energy. Our order book as on 31st December 23 is rupees 22,792 crores. And this comprises mostly of warship building orders, and we are currently executing 4 projects for the Indian Navy. There is a P-17 Alpha project, 3 warships, the anti-submarine shallow watercraft project, 8 ships, the next generation ocean-going patrol vessels, 4 ships, and 3 survey vessel large. Now, this survey vessel large is a 4-ship project, and we already delivered the first ship as recently as December 23. And that is the largest survey vessel to be built in India. And for the record, we have so far delivered 71 warships to the Indian Navy and a total of 109 warships to the maritime forces. That means the Navy, the Coast Guard, and a couple of friendly foreign nations. So we are doing well. And coming to green energy, this has been a focus area for us. And this is an area where we see huge market potential. Considering, in our appreciation, the inland water transportation segment of India would, in all reality, go green in the next 5 to 10 years. Considering that we had made a foray into this, and as we speak, the handing over ceremony of the first green vessel that we have built for the government of West Bengal. And again, this is the largest to be built in the country in terms of passenger capacity that is going on today. The vessel has already undergone successful trials and it is being handed over today.
Sure.
Now,
Mr. Hari, if you can just help us with some numbers, what exactly would this entail in terms of the amount of orders? in the green energy space. And also, your total order book currently is somewhere around 23,000 crores. What is the kind of order visibility that you have over the next 12 to 18 months? And what is the order execution that you're planning to do of this order book?
Okay, I'll first address the execution strategy. The current order book, as I mentioned, is 22,792 crores. And as per our execution strategy, this order book will be executed. This 18 warships plus our balance orders will be executed by FY28. And what are the orders on the anvil? Now, both the Navy and the Coast Guard are on a massive fleet expansion drive. And coming to a project that we have been eagerly looking forward to, that is the next generation corvettes for the Indian Navy. We expect the RFP to come out during the current calendar year, that is mid of 2025.
Mr. Hari, we're just going to, fix the bit of a technical snag that we have. And we're going to come back to you because we want to hear out the numbers that you're giving us. As we do that, just do a quick market check. The advanced decline ratio got a little closer to each other, and now they're moving apart again because there is a good recovery that we've seen. The Nifty, from being down close to under 100 points, it's recovered. Now we're down less than 50 points. The Nifty Bank, as I said, that's playing a good innings. Well, that's up close to around 100 points odd. And what's leading the recovery? Well, you have a few stocks. BPCL, you have a cooling off in oil prices. BPCL likes that, so that stock has moved up. Apollo Hospitals as well, that's one of the big volume movers right now. And Bajaj Auto is another one that's done a U-turn. So good move out there.
Absolutely. And even Amber Enterprises, right? 5% higher now. CLSA has upgraded Amber to a buy and they've raised their target price to 4,300 on the stock. That one is really surging now, 5.5% higher. But I think Mr. Hari is back with us. Sorry, Mr. Hari, we had some audio issues. You were telling us about the order execution and also what is the order visibility over and above this 23,000 crores order that you're sitting on. What's the order visibility over the next 12 to 18 months?
Okay, order execution by FY28, the current order book, order visibility. We are expecting the RFP for the next generation corvettes to come out by mid of this year. That means around June, July, the RFP could come out. And this is a high value order. 36,000 crores is the AON that has been taken for this project from the DAC. And we, considering the RFP to ordering stage, we expect the order to be placed by mid of 25. And this is a 8-ship project. 36,000 crores split between 2 shipyards, the lead shipyard getting 5 ships. So we are targeting that 5 ships. And that comes to around 22,500. In addition to that, Navy also is likely to come up with RFPs for the next generation survey vessel. 5 of these vessels, around 3,500 crores. That is the likely value. 2 multi-purpose vessels, around 1,200 crores. And of course, what we are eagerly waiting for, the P-17 Bravo ships. We are currently executing the P-17 Alpha 3 ships, and we expect this order to be placed during mid of next year. So this is what is likely in the next 12 to 18 months from the Indian Navy. In addition to that, even the Coast Guard has got requirement for 18 FPVs and 6 ocean-going patrol vessels.
Okay. All right. Hi, Mr. Hari. Good morning and good to see you. When, as you started off, you said that the financial performance has been very good according to you, and you've seen growth consecutively for close to around 7 quarters odd. And going by all that you're saying, the order pipeline looks like around 1 lakh crore odd, and you'll be looking to get, a lot of orders out there. But I want to focus a little bit more on the execution. You have told us most of these orders will be executed by 2028. I'm looking at a brokerage note. And in FY24, they are estimating that you do around 3,400 crores, which appears you're pretty much on track. So 3,400 crores. The following year goes to around 4,100 crores. And by FY26, will you be closer to 5,000 crores, sir?
See, you're absolutely bang on because 22,700 crores we are left. And as I mentioned, they will be executed by 28. You're right on target. It could be around those figures that you mentioned.
Right, so we are going with 3,400 crores, followed by 4,100 crores and 4,900 crores.
It would be, see, as of 31st December 2,577. So mathematics and logic and our current execution strategy and the project maturity phase indicates you are on the right track. We are on the right track.
So let's talk about 26 at least. Around 5,000 crores is definitely on the cards, right? By FY26.
One of these years, either FY25, 26, we should be crossing the 5,000 figure.
Oh, that's interesting. So it could be earlier than anticipated, maybe FY25 or 26.
Let us see. You see, the P-17 Alpha is our major project where the maximum revenue accrual happens. And this project is right now in a phase where the equipment are going in. So we expect revenue contribution from this project in a substantial manner in FY25 and 26.
Okay, and the margin number that you want to give us, the PBT, I think you were working with 8-9%. Could you just revise that number before we let you go, Mr. Hari?
We'll maintain the same similar margins in terms of both the PAT and PBT.
So that's around 8-9%, right?
Yes, affirmative.
Okay, 9% margins affirmative, and looking at more opportunities in the whole green transition space with regards to stripping as well. Mr. Hari, thank you very much for joining in and giving us a business outlook. That's Garden Reach Shipbuilders. By the way, look at the screen. So it's not just the broader markets that are now, doing well. There's a Friday feeling on the street. The reason I say that this 0.5% dip that the Nifty was sitting on, that's getting bought into. And it really is a lot of the other heavyweights to the rescue. So you've got ITC, for instance. The banks are powering through. The bank Nifty is actually up 0.25%. ICICI Bank, SBI, Axis Bank. These are some of the names on the upside. And then, of course, some of the select pharma stocks like Sun Pharma, Cipla, they are also doing well. So it's a green screen, mid-cap index, small green, bank Nifty green, and Nifty quickly racing towards the green side. So let's see how it plays out. Take a break. We'll come back and look at commodities with Manisha Gupta.
This is actually not a bad outcome for the market at all. It's absolutely flat despite the kind of pressure that we're seeing from IT space, which indicates that X of IT, this market is actually doing very well. And there's lots happening in the broader markets. Banks are participating up 150 points, and the mid-cap index is also doing a good jig. Despite the headline index being flat, there's lots happening beneath the surface. Nagaraj Shetty of HDFC Securities is joining in. Nagaraj, hi, good morning, and thanks for being with us. My overarching question to you is that have we seen the worst of this market fall that we saw in the last couple of weeks? Do you think this 22,000 level is something that the market can conquer, and can we build on to it in the days to come?
Hi, good afternoon. Recently, we have a correction. We have seen, I think, market seems to have bottomed out around 21,700 levels recently, and the market is consolidating at the higher levels. I'm expecting the next hurdle would be around 22,200 levels. There could be some consolidation at the highs, and eventually market could move into a new all-time highs about 22,500 levels. This is going to be a buy and buy on dips opportunity for the market in the near term.
Okay, what about on individual stocks? Before we get to your own picks, what do you do with IT names? Do you buy the dip or do you stay away?
Yeah, definitely. IT is going to be a buy on dips opportunity. We have seen some good momentum on the downside in the IT sector, in the IT major stocks. I think this is going to be a buying opportunity in the day or two. The dust will settle, and I think IT sector as well as the prominent IT stocks could form a bottom reversal at the lower levels, could start moving up.
All right. Hi, Nagraj. Good morning. Do you want to fill us in with some picks as well?
Hi, good morning, Nigel. I have two picks. First one is Ion Exchange. Particularly, if you look at the stocks, Ion Exchange was in a downtrend over the last many months, and recently made a rounding bottom type pattern and bounced back sharply in this week. It has moved above the resistance of downsloping trend and currently trading around 500, 501 level. One can look to buy at this point of time. 530 is going to be the next upside target for the stock, and one can place a stop loss at 480. The second one is HEG. Chartically, if you look at HEG has been in a strong uptrend recently. After a small correction, it has moved up sharply recently in the last two sessions, and currently moving above the resistance of downsloping trend line. The overall chart pattern is looking positive, currently trading around 2010 level. One can look to buy at this point of time. 2175 is going to be the resistance, the target for this stock in the near term, and one can place a stop loss around 1940 levels.
Okay, got that. Thank you very much, Mr. Shetty, for joining in and giving us a lot of those trading ideas. Thank you for that. So equity markets are not doing bad, actually. Let's now shift focus to commodities and figure out what's happening over there. Manisha, it was all about the central bank feel-good factor yesterday. How is it looking this morning? Oh, well, yes, and we did see a lot of knee-jerk reaction come in for the prices. It was a relief rally that we saw in many of those commodities. But today it seems like a day where there is some sustainability, even a bit of a profit-taking, because after the Bank of Switzerland actually did cut rates, we have seen the US dollar index gain, and that has led to prices cooling off a bit. So and then apart from that, it also has been slight profit-taking because the prices had run up quite strongly. But there is a lot of support still in metals because of the strong Chinese data that we have seen in last couple of weeks that has come in. So whether it has been about fixed income, retail, production, manufacturing, all of their data came in better than the street expectation. Also, the US Fed rate cuts going forward is supportive as a sentiment, and there has been stockist and mills buying metals on the lower levels. That has been supportive as well. I'll talk about nickel first, and we were trading at a 1-month lows, but we have seen prices gain up slightly. So this one is trading at around $17,000 a ton in Asian markets right now. Good gains, and even with the bit of a profit taking that we have seen in Asia, most of the metals are trading on the higher side of the range. So you have aluminum prices still trading at around 11-week highs. Remember, China has been importing big numbers of unwrought aluminum imports, and we have seen 93% of gain in the month of Jan and Feb on an year-on-year basis onto this one. Not just aluminum, lead LME stocks also stand at an 11-year highs. We have seen the ferrous metals actually gain up slightly. So iron ore prices, which were trading at a 9-month lows of around 102 a ton, have surged beyond $108 a ton. Steel prices, which were holding at around 4-year lows, also have seen some buying. So when you talk about this week, we are looking at 3 to 4% of gains coming in for both the ferrous metals. Copper as well continues to hold around those 11-month highs. There's a very strong statement from Trafigura, which is the largest commodity trader in the world, saying that they are very bullish in copper because of the underinvestments, and by 2030 they're anticipating a deficit of around 5 to 6 million tons when it comes to copper. A very interesting development also that you would want to know is that until now, when you look at metals globally, you look at LME and New York and the Chinese markets. Now LME is planning to list Jeddah at the Saudi port for copper and zinc delivery points. Well, we have been looking at Saudi Arabia, where they want to move away from energy and include minerals, mining, logistics into their portfolio. So we do understand that with the subject to proposal consultation, in the next 3 months, you could be looking at Jeddah and Saudi Arabia as well, as far as the metal prices go. The last chart comes in and brings to you on what we have seen in sense of prices on a weekly and a monthly basis. So copper prices have seen a bit of a decline after that all-time highs that we saw in China on a monthly basis, still in the positive. But the best of reaction in this week clearly has come in from the ferrous metals, 2.5% and a 4.5% of gains coming in for iron ore and steel. So absolute opportunity and strong buying that we've seen from the lower levels.
All right, thanks a lot, Manisha, for that. Let's take a quick break. On the other side, we'll put focus on the big cricket season. IPL kickstarts today, and we'll talk about the business of IPL, the franchisee, and a lot more. Stay tuned for that discussion next.
Welcome back. Well, the markets have seen a good recovery. We're moved to the high point of the day. The Nifty Bank is up close to around 200 points, so things are looking good. But for all you cricket lovers, well, the Indian Premium League will be getting underway later this evening with the Royal Challengers Bangalore facing off against the defending champions, the Chennai Super Kings in Chennai. The match will begin at around 8 p.m. today. But Mangalam's here to decode the business of IPL with some interesting data as always. Mangalam, take it away.
Well, we're all set to kickstart the IPL 2024. But before that, let's put some numbers from 2023, the last season, in perspective. The last IPL saw nearly 500 million viewers watching over 43,000 crore minutes of content, with the finals seeing nearly 6.5 crore people watch together. For most of the games, there were about 3 crore peak concurrent viewers online itself. And that wasn't all. For TV as well, the growth was 32% in ratings. As we move to the business of the IPL, let's understand from a franchise owner's perspective. So this would probably look like an income statement of a franchise owner. The franchise fee, which is about 20% of revenue for old franchises, and fixed fee for new ones, is an expense for them. Players' fee, along with operating expenses, are the key cost heads. Whereas share of revenue coming in from the central revenue pool, central media rights, sponsors, and some ancillary revenue coming in from gate sales, ground ads, and merchandise are the key income heads for a franchise owner. Of the central revenue pool that accrues to the BCCI, 50% is retained by them, and the other 50% is distributed among the teams. What is the annual income for the BCCI through the IPL? It's roughly 5,000 crores, which comes in through media rights, about 1,350 crores, which comes in from franchise fees, and title sponsors, which give in close to around 500 crores. The BCCI keeps 50% of that, and the remaining 50%, like I said, is distributed to the teams. How do the actual numbers look? Last year's champions, Chennai Super Kings, made a revenue of close to 273 crores and an EBITDA of 65 crores as well. And now we have the list of their revenue sources and income heads. This is from the CSK annual report. Player fees were close to around 92 crores, franchise fee 50 crores, tournament expenses of around 40 crores, for which they got revenues of close to 200 crores from the central piece and sponsorship revenue of roughly 80 crores. But here's the game changer, the valuations. The valuation of some teams has grown to over 20-25 times since the beginning of the IPL in 2008, and the IPL itself has become a decacorn, which is basically over $10 billion in terms of valuation as per Duff & Phelps. So the question then is, from an investment standpoint, what are the listed plays here? Well, we have United Spirits that owns the RCB, Sun TV that owns the Hyderabad Sunrisers, and the RPSG Group's Lucknow Super Giants is partially held by RPSG Ventures. So as a percentage of market cap, the valuation for United Spirits or RCB is about 15%, for Sun TV is about 35%, and for RPSG Ventures is about 150%. But of course, there is a lot of valuation discount or holding company discount that will play out as well. So that's the business of the IPL. Now that you know about it, sit back, relax, and enjoy the games.
All right, Mangalam, thanks a lot for that. And come back here and, let's have a couple of guests who join us on the show right now. Karan Turani of Elara Capital, as well as Vineet Karnik of Group M joins us on the show. Hi, good morning, gentlemen. Thanks so much for joining in. Karan, let me come across to you first. Two-part question. Who are you betting on, first of all? Who do you think is going to lift the trophy this time around? And then, since it's market hours and we're tracking the markets, tell us who are the key beneficiaries.
So I think I'm betting on CSK. I'm a very big CSK fan. I think this year, again, they'll emerge champions. So, yeah, and secondly, in terms of the market impact, I think, as Mangalam pointed out, that, all of these companies have got a listed parent associated to them. And in terms of potential delta, I think, Sun TV is the biggest delta here. Close to 1/3 of their market cap is coming from the IPL valuations. So I think this year, rather FY24, we are going to see a turnaround in terms of IPL revenues for all the teams because of media rights, right? So last year was the first year when, IPL operated after the renewal of media rights. If you look at the overall rights value, that went up by 3x. And if you remove including the number of new matches that were added in this fresh cycle, the actual value has gone up by about 2.5 times. So most companies are going to report a growth of, about 2 to 2.5 times on their IPL revenue, because almost about 80% of the team's revenue was because of media rights, which has seen a surge after this new cycle which is coming.
All right, Karan. So hang in there, because also with us is Vineet Karnik, who's the executive director at Group M and the author of Sporting Nation, the final word on the sports market in India for the last 11 or 12 years. Vineet, thank you for joining in. So let's talk about numbers itself. Karan said that, 80% of the revenue is coming from media itself. So what are the expected numbers for IPL 2024? What's the kind of growth that you're expecting over last year?
Yeah, so it's a very, very forward-looking and an optimistic 2024 from an IPL's perspective, okay? Because we have seen a very, very constant growth within the IPL ecosystem from a commercial standpoint. So 2024 is not going to be any different. We're very, very optimistic about the growth in 2024 as well. Just to put this into perspective, we have already seen a great amount of thrust on the central sponsorships already, okay? So in our estimation in 24, the central sponsorship pie itself will grow around 20%, okay? And 20% on a very already high base, okay? Because we have seen Tata's putting 500 crores on table for title sponsorship. We have seen the OPs, which is the central sponsors, going up significantly. So there is a significant increase in sponsorship interest. from a central sponsor point of view. From a team perspective, I think we expect a growth of about 15%, and that's been a very steady growth year on year. 12 to 15% is what it varies. In 24, we expect a 15% growth in team sponsorships as well. So that's a very encouraging sign, and looking forward to a cracker of a season starting.
Hi Vineet, good to have you on the show. Well, WPL just got over. What was the response like when it came to numbers? If you could help us out on that front.
Yeah, absolutely. So WPL, great initiative again. I think the fans have really embraced it last year. And this year, we definitely saw a decent growth in advertising as well. We estimate in 2024, while we are still doing the numbers because the season just got over last week, but we definitely expect a steady growth of about 10 to 12% in WPL this year. More importantly, what's notable in WPL is the kind of support WPL got in terms of the on-ground, fans wanting to go and watch the matches in the stadium. You saw most of the matches. Look at the finals. Most of the matches you had more than 50 to 60% capacity in the stadium. So that's very encouraging. And in the world of sports, what we believe, if you have got seats in the stadium, I think you will have definitely more audience watching it on TV and on OTT. So that's very encouraging. And obviously it comes on the back of a very, very strong Indian team in terms of our women cricketers. They have done exceedingly well in terms of the global circuit. They have been world beaters, and they have played fantastic cricket over the last season.
Indeed, fantastic cricket. I was heartbroken because Mumbai Indians, the women's team, could not proceed to the finals. But then we had RCB do what the men's team didn't do. They went ahead and won the WPL itself. But Karan, coming back to you now, you did speak about a lot of these listed parents that are there, which are limited just to 3 teams right now, 2.5 teams, so to say. But from the entire IPL, there should be beneficiaries like QSRs, some of these beverage companies. It's summer season. You would see Zomato as well as a beneficiary. Could you quantify the kind of benefits that one can expect?
Yes, of course. So if you look at the QSR and the Alcobev companies, they will have a strong quarter. But I think, IPL is something which is there every year. But this time we've got the T20 World Cup in the month of June. And if you look at the matches, again, the timing is very favorable at about 8 p.m. is when they start. So definitely, Zomato will be a big beneficiary here. In terms of the order volume and the traffic, and also the beer segment within Alcobev segment, because people go on premise and, consume drinks as well. So I think these two are going to be the beneficiaries here. But IPL is an every year phenomena. So no such big delta, from IPL, because this quarter we also have the elections. And because of that, we'll have dry days and, movement will be restricted because of that as well.
Karan, you gave us the valuation of Sun TV, Sunrisers as a percentage, I think, of Sun TV's market cap. I think you said a third, right?
Yes, right.
And for United Spirits, RCB, what is that comparison right now?
So that's about 12 to 14% for United Spirits RCB. So I think most of these IPL teams, as I said, they were doing a revenue of about 250 to 300 crores, which potentially in FY24 will move towards 500 to 600 crores because of the media rights. And the EBITDA margins are also very strong for all these teams. They make close to about 50% plus EBITDA margin. So it's going to be a big positive impact in terms of, PAT for all these companies.
All right, let's bring Vineet back in. Vineet, you said that, 80% of the revenues for the business still comes from broadcast and sponsorship itself. But a small but fast growing revenue pie is the ones that these teams make from their digital media and merchandise sales as well. What kind of numbers could you target for this in this year?
Okay, so as I said, ancillary revenues in terms of the digital channels of some of the teams has been very encouraging. They're not very, very significant if you compare that with the sponsorship revenues. But I think merchandise and digital media put together would be about 5% at this point in time and growing. Yeah, so that's an encouraging sign. Merchandising, mind you, has not been a great trend in India as we started the IPL in 2008. But over a period of time, I think we have cracked that code, and through some of the e-commerce initiatives, I think we are doing fairly well.
All right, with that, let's wrap it up. What was the size of the sports business in 2023, Vineet, and what do you expect it to be in 2024?
So 23, we have seen a growth of about 11%. It has grown from 14,000 odd crores to about 15,766 crores. And now we can't say that we have a low base. It's on a decent size of a base, right? So that's very encouraging. I mean, in fact, just to put things in perspective, the sports industry has grown at a CAGR of 13.3% from 2008 onwards consistently. Okay, so in 2008, this business was size of about 2,400 crores, and today it's 15,766 crores. That's a huge incremental that we have seen over the last 16, 17 years.
All right, Vineet, thank you for putting those numbers into perspective. Karan, thank you for joining in and putting the listed space into perspective as well. You are a CSK fan. I'm a Dhoni fan. Yesterday was an end of an era with Dhoni stepping down of CSK as the captain. Nigel, I'm gunning for Mumbai Indians. What about you?
I'm a loyalist. Mumbai Indians for sure.
All right. On that note, we'll both shout Mumbai, Mumbai and wrap up on this edition of Bazaar. Chartbusters comes out next. Stay tuned.